and the Fed are increasingly open to the prospect of perhaps a quicker hiking and tightening cycle.
The market has repriced the hiking cycle significantly.
The market's been very quick to price out interest rate hikes by the Fed in the middle of next year.
From a Fed's perspective, the fact that the terminal rate is not rising gives them less room to hike.
We don't think that they'll actually be raising rates until 2023.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
All-time highs coming into Tuesday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market up another 19 on the S&P, advancing 0.4%. Tom Keene, we had the drawdown. It didn't last long. This is what you're calling the draw up?
Well, I've been calling it the draw up, looking at the traditional definition, but the draw up from the beginning of the pandemic. John, this is really, really important. I've never done this in my career. I'm taking earnings comparisons back pre-pandemic, basing off 2019. So if you look at the draw up from the beginning, before the pandemic, the Dow up 22% off the good news of early February of 2020. SPX up 35%, NASDAQ up 60%. And the answer is forget about 2020, and the market seems to be doing that this morning.
This market has ripped back, Tom Keene. The NASDAQ included 1% away from that high in September 7th. Let's talk about Tesla. Can we say congratulations, please? Elon Musk. Tom Keene, a $4.2 billion deal adds $120 billion to the market cap of Tesla. We have a $1 trillion stock, Tom.
All the media is looking at Eric Schatzker breaking that story yesterday on it, and it's a different Tesla this morning than maybe a week or 2 weeks ago. John, it has log convexity. That's fancy talk for acceleration. It was accelerative yesterday up over that $1 trillion statistic. I mean, just absolutely just stunning.
Lisa, you've got to love Elon Musk. Strange that moved the valuation, as Tesla is very much a production ramp problem, not a demand problem. The words of Elon Musk.
Elon Musk about to become almost twice as rich as the next richest person in the world. I just want to note the fact that he might become the world's first $1 trillion man. Look, people pointing to the fact that Tesla still has a junk rating. My question is, what does this indicate? That we're looking at companies that have gotten ahead of their skis in terms of valuation, or that, frankly, everybody else is behind the curve and trying to figure out what these companies are? Is it a car company?
Well, we know what UPS is. Tom Keene, that stock's up 2.5%. The earnings come in. It's a beat and a raise into year-end for UPS. Adjusted EPS coming at 271, Tom. The estimate, 254. So a nice beat for them. The stock's up 2.5%.
Out of Atlanta, they're rooting for the Braves against the Astros. And, John, it's real simple. I do care what UPS and FedEx do. They permeate the American economy, maybe somewhat like Amazon as well. And I see guidance there up, and that's the tone you see in the tape this morning.
Beat and raise. Much more still to come this morning on the earnings front. Here's the price action for you as we kick things off this morning. Equity futures up 19, advancing 0.4%. Yields in about a basis point to 161.85. TK, what was Kit Duke saying about euro dollar? 116.18.
Well, it's range bound, and this is something we've talked about. It's something we've struggled with, and you've got the equity dance going on, and there's some interesting in the yields. Crescenzi coming up here. Must listen for Global Wall Street in a moment. But a lot of some other stuff just stuck in the water. And Kit's looking back to 1999, not synthetic euro, but back to the advent of the euro. And the euro's done nothing for a brief moment here, like it's never done nothing before.
President Lagarde coming up on Thursday. Lisa, that ECB decision a couple of days away.
Yeah, interesting to see what the ramifications are in markets where the yield curve flattening has a lot of people's attention. Today, I think, is going to be fascinating when it comes to economic data. We get two sides of the same coin. How much are higher prices dampening consumer confidence? At 10 a.m., we get U.S. September new home sales. An hour before that, 9 a.m., we get the idea of how much housing prices have been going up. The expectation is for it to be 20% year over year, although a deceleration in the pace of increases. How much does this dampen appetite for homes? And then also at 10 a.m., we get consumer confidence, the latest reading. How much is consumer confidence coming down? The expectation is for just a little bit of a dampening, but really the story of earnings has been that dampening consumer confidence has not bled into any kind of slowdown in revenues. Then today, an FDA panel is meeting to discuss vaccinations for 5 to 11-year-olds. I know I'm watching this very closely. Tom Keene's watching this very closely. We all want to know when our kids can actually be inoculated. Meanwhile, frankly, the interesting thing to me is that the pickup in terms of who's getting vaccinated goes up as far as a proportion of the overall population as people get older. How much of a pickup can you get in the 5 to 11 set, even after we have a vaccine out there? And then aftermarket, Alphabet, Microsoft, and Twitter all reporting. Interesting to see the diverging stories. How much is it a cloud story when it comes to Microsoft, when it comes to Google, where shares have just been on a tear? I mean, we talked about Microsoft and how much shares are up there, but Google shares, Alphabet shares up 58% year to date. How much is this a tech story, and how much is this a cloud adoption story, and how much does that diverge from the social media giants and Twitter?
Just call it Google, Lisa. We all call it
I knew
Google.
you were going to call me out on that.
I know. It's okay. Tom does too.
You know, what are they going to do with Facebook? What's the name of Facebook?
We'll keep calling it Facebook, whatever they call it, Tom.
Mirage.
Okay.
Moving on.
Facebook. No, let's not do Facebook. Tom, Microsoft. The quiet rally in Microsoft, up almost 40% this year. It's something year to date.
Yeah, it is. And Microsoft's there. Joe Feldman publishes definitively on Amazon this morning, John, as Lisa mentions the cloud as well. He's staying with cloud growth at Amazon. Did you notice, John, I'm going to say this as an amateur, the British Secret Service or whatever decided to go Amazon cloud, an uproar
I
in the
missed
UK.
that one, Tom.
Yeah.
I missed that one. When you begin a sentence with a little bit of an amateur, it doesn't bring you much credibility for what you're about to say.
Well, I'm just trying to be honest. I mean, what do I know about
I appreciate the honesty.
What I like about Feldman is he's got EBITDA margin 16.7%, and UPS, United Postal Service, just comes out and they raise their operating margin, John, to 13%.
Beating a raise, the stock likes it, Tom. Likes it. Tony Crescenzi joining us now, market strategist and portfolio manager at Pimco. Tony, this cycle is moving so quickly. That's the story at the epicenter of your outlook with you and the team right now. Can you just walk us through how you're thinking about the world around us at the moment?
Well, we when we like to talk about the yield curve, and the yield curve movement speaks to this idea of a fast-moving cycle. It does seem like the economic cycle is moving at warp speed. Think about it. We're probably at mid-cycle, meaning look at the unemployment rate, 4.8%. What is a late cycle condition? Of course, an unemployment rate that's lower, and that lower rate could be achieved, full employment, next year. So that's a fast-moving cycle. In fact, the Federal Reserve is projecting that the unemployment rate will be in the mid-threes by the end of next year. So for investors, it's important to be on your toes. It's a simple way of saying it's important to be active with portfolio management, to be thinking more about security selection, regional selections, et cetera, et cetera. And it is a fast-moving cycle. One final note: that the yield curve, again, it has flattened recently, and that's something that happens later in the cycle because the Federal Reserve is raising the short-term rate, which pushes up its yield relative to the long-term rate, flattening the curve.
Tony, that's where I want to go. 210 spread this morning, 118 basis points. Tony, where is the 2-year yield that matters to you? We're at 0.44%. Just in your mind, Tony, where's the 2-year yield a tip point or a critical point for Crescenzi?
Well, the 2-year relative to other yields matters a lot. I mean, it's just that the 2-year will tell us about the 2-year window. And we know that the market's looking at shorter term interest rates and forward interest rates like Eurodollar futures is projecting that the Federal Reserve will increase its policy rate sometime next year, perhaps as early as June. The market's penning in several interest rate hikes. But there's two extraordinary things about the 2-year to 10-year spread. One is the fact that the spread started to flatten earlier in the cycle than we have seen since the 1980s. And then in the last 3 cycles, the last 3 recessions, the spread between the 2 and the 10-year note was as wide as 300 basis points. In other words, the markets were patient about the idea of Federal Reserve interest rate hikes. It thought that interest rate hikes were somewhere out in the distant horizon. And so longer-term yields had stayed high. But now, this is the peak this time was 150. So it was half the level of the previous cycles, is to cut to chase. The second part of the extraordinary part about the yield curve 2-cent spread is that the 10-year yield is projected to be low. And on Bloomberg, a function for you Bloomberg users, FWCM, it shows forward interest rates. And you see the market is saying that there's a benign story to evolve, unfold over time, that interest rates probably won't get above 2.5%, even as far out in these forwards as I look at the table, calling it 10 years plus.
Well, but Tony, just to sort of tie this all together, then what is the message from the yield curve? Is it that the market, that the economy can't necessarily handle too much tightening from central banks? Or is it just that the margin is going to naturally be narrower because of this ceiling on longer term yields?
Lisa, those are probably the conclusions that most would draw from it now. But perhaps forward interest rates are wrong. Perhaps the market, the consensus, and that's embedded in these forward rates, is wrong in thinking that the 2010s it will be repeated in the 2020s. But the 2010s is probably the wrong analog for the 2020s. There's a lot going on. In Pimco's secular outlook, we speak to transformations, for example, becoming more digital, more inclusive, more green. Those are the three major transformations we see. All of those things could, we're not saying they will, result in faster growth. And simply doing the math, if economic growth is 4% as the Fed projects next year, and Pimco projects as well, then looking at the next 5 years, even if growth is 2% in the subsequent 4, we'll still have a rate that's about 2.5. So that would be a lot better than the 2010s simply just by that math. And so it's possible the growth is faster, and these forwards are wrong, and therefore rates will go higher. We're not suggesting that rates will go materially higher. In fact, we would say we may return to certain old normal conditions, but with new neutral characteristics, which is to say that, yes, Lisa, that the Federal Reserve can't raise its interest rate too much because of debt loads and certain other factors.
Hey, Tony, we're out of time. Haven't even got the time to plug your book. Got to let you go. Tony Crescenti there.
Thanks, John.
Pimco. Hey, Tony,
Lisa.
Thank you. Good to catch up, as always. Bit of news out of China, Tom. There is a developer in China you might have heard of called China Evergrande. China's urging the founder to pay the debt with personal wealth, asking some firms, Tom, to prepare for offshore bond payments.
It's a different formula.
You think?
I don't know what to make about it. You know,
I think it reads. That's how you make of it, Tom, just as it reads.
I don't.
All right, okay, you don't want to go there. Feel that. Tom Keene, Lisa Abramowicz, Jonathan Ferro from New York City this morning. Futures up 19. Care to comment? No, up 0.4%. Still don't care to comment. Okay, from New York.
Okay.
I'm sure you'll jump in right at the end now, just as I'm going.
What's the Dow doing?
Okay, this is Bloomberg.
With the First Word News, I'm Laura Wright. The US and Chinese governments have made some incremental progress in their economic and trade negotiations. Treasury Secretary Janet Yellen and China's Vice Premier Liu He held their second call in around 4 months. Beijing described the conversation as pragmatic, candid and constructive. China has repeatedly said the US should lift tariffs on Chinese exports imposed during the Trump administration. Senate Democrats have moved closer to an agreement on President Biden's economic agenda. Senator Joe Manchin expressed optimism there could be a deal this week. He's been pushing to shrink the size of the social spending package. Still, some House lawmakers raised doubts about the terms of the deal being discussed. Hong Kong will soon end most of the quarantine exemptions for overseas and mainland travelers. The city is under pressure from the Chinese government to tighten up what is already one of the world's strictest coronavirus containment programs. Hong Kong's goal is to eventually reopen the border with mainland China. In the UK, Chancellor of the Exchequer Rishi Sunak will end the pay freeze on public sector jobs. Sunak will make the announcement in his budget tomorrow. The pay freeze took effect for 2 million workers in April. The Treasury cites what it calls the strong economic recovery as a reason to raise salaries. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Went well. A few more things to work out, but it went well.
Do you think you'll have a plan before Wednesday?
With the grace of God and the goodwill of neighbors.
Do you want to plan a deal by the time you leave for COP? Is that something you've expressed to Democrats?
That's my hope.
A lot of hope in the past 24 hours. From New York City, that was the President of the United States. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. This Tuesday morning, all-time highs coming into Tuesday. Equity futures up 19. We add some weight to the recent rally, up 0.4%. The Nasdaq gapping aggressively lower from September 7th and then eating its way all the way back, Tom, to within 1% of a record itself. And the FX market, euro dollar 116.16, and crude pulls back, TK. We're down 0.4%, $83 and about 40 cents.
You really reaffirmed, John, we are really going into the heart of this tech earnings stream today. And I don't think, John, we expected earnings from non-tech companies to be this buoyant. I just think we're not where we thought we would be right now.
The likes of UPS doing pretty nicely this morning, Tom. And within sectors, winners and losers, we saw Unilever raising prices, passing them on to the consumer. We saw Kimberly-Clark struggling, Tom, with costs.
And again,
there's a story of different winners, different losers, as you might expect any earnings season, Tom. But it hasn't been that broad story where the whole market gets dragged down.
Yeah, Liz Ann Saunders with a brilliant tweet on that overnight on the beneath the market. There's some really interesting dynamics. Beneath the politics of this nation, there are some really interesting dynamics as well. Joe Matthew, now our Bloomberg Washington correspondent. The president can waltz out. He can have a televised moment, Joe, and say, let's get it done. Who is doing the let's getting it done as we try to get it done this morning in the white marble of Washington?
Well, it's the leadership, really, and I say that, Tom, because we've been talking to lawmakers every day here in the Washington Bureau. I do on my program, and I speak with, in many cases, sources close to committees that matter. Think the Rules Committee, for instance. They don't know what's coming next year. They're waiting for cues from Nancy Pelosi, from Chuck Schumer, and they are waiting for cues from this White House. And, of course, all roads lead to the gentleman from West Virginia who we're still talking about here. You've got the president saying, by the grace of God and the goodwill of the neighbors. I'm wondering if Joe Manchin should be the one going to COP26 next week, because as these climate provisions slowly leak out of the plan, it's unclear what the president will be able to show for it.
And, John, the chemistry of this is really serious, John. I mean, it gets right down to methane. Did you notice, John, how Matthew got his show plug in the second sentence?
I did, and we'll do that again at the end.
It's just...
Joe, we will get there. Don't worry. You don't have to do it yourself. We do it at the end of the conversation. We do a nice graphic as well on TV.
It's my baseline, guys. What can I say? It's
where I talk.
Joe, it seems to me that down in Washington, the president is negotiating with one man, Senator Manchin. That's not news. We're all familiar with it. Is he negotiating something that will actually pass this House? Because that's what confuses me at the moment.
Well, same here, and it's really unclear. We're still talking about the same 10% that's been left over where it's paid family leave, right? Proposed expansion of Medicare and climate, and we've really been focusing on climate in advance of COP26. I think I heard Tom mention methane. That's the latest one. You got the clean utility component out. Joe Manchin also opposing a fee on methane emissions. So is Joe Biden going to go to Europe and talk about incentives for EVs, that's the centerpiece of the progressive Democrat approach to climate change? They were hoping to have a heck of a lot more than that. And as we look down for the next several days, it's possible you get a vote on the bipartisan infrastructure bill. By the way, that had incentives for EVs. They didn't have to knock their heads together for 6 months over this reconciliation bill to get that. So President Biden could be wondering as he gets on that airplane exactly what he has to show for it, other than credibility. Maybe that's what this is. Competency, credibility. Look, guys, we got something done. And while he's showing off what got done for world leaders, it will resonate here. I just want to remind everybody that 1 week from today is an election day, and it's an awfully important one around here in Washington, D.C. with this gubernatorial election next door in Virginia.
Okay, so what's enough to get the physical infrastructure bill over the finish line? I mean, this really seems to be the key issue. What counts as an outline for the human infrastructure plan, enough to get finally something actually passed that everyone agrees on in Washington?
It's a great question. I'm not sure anyone really has the answer to it. How long should the paid family leave be? What's the duration of the child tax credit? And will there be an expansion of Medicare that Joe Manchin can accept and doesn't believe will leave the rest of Medicare insolvent in a couple of years? Those questions have been unanswered. We have seen progressive Democrats continue to dig in. Pramila Jayapal, the chair of the Democratic Progressive Caucus in the House, is already saying, next week, maybe we'll vote next week. How many weeks can we do this? I've been talking to you guys for months every week about this, and it seems like it always gets right up to the edge, and then we delay things for another week, and that could happen again.
You and I were weaned on the realities of one Tip O'Neill. I would suggest that Mr. O'Neill never overreached. What's the Matthew overreach gauge right now? Is this a Democratic Party massively overreaching?
It will look like that until something is done. I just would remind Tom and everyone, $1.2 trillion on infrastructure. Let's say they get 1.75, maybe just shy of $2 trillion on reconciliation. The Democrats will have $3 trillion in new spending, programs that never existed before, and get it all done before the end of the year. That may sound like an overreach to you, but it would be a huge victory for Democrats, just as we're planning for this whole thing to fall apart again. Remember as well, it took Obamacare 9 months to get done. So this could last a little bit longer.
It's a good point, Joe. Here it is. Drum roll. You can catch Joe on Sound On.
All right. Nice.
On Bloomberg Radio. Weekdays at 5 p.m. Eastern Time. Can you tell which bits of this show are scripted, Tom?
Yeah, you
Joe,
can.
thank you, sir. Joe Matthew down in D.C. Joe, we appreciate
Thanks,
it. Tom, the optimism of the last 24 hours, is it warranted in your mind?
Yeah, well, I mean, the optimism in Washington, I don't know.
Around getting something done.
I don't buy it for a minute. You know, they'll come up with some form of decision, and Glasgow seems problematic, as we heard from Prime Minister Johnson yesterday. John, on GE earnings coming out, you know, I'm going through the PowerPoint right now, and again, they're raising a margin view, but on flat revenue growth. This needs more study.
Make it very simple, Tom. What they see now is better than what they saw previously.
Yeah.
Fair to say? Working through the supply side disruptions, a work in progress. And Lisa, what they see now is better than what they saw previously.
This, to me, has been the underlying story, even as we see supply chain issues and, frankly, labor market shortages. The idea that the optimism still is the prevailing sentiment, and that is the story also with General Electric.
Rock solid, resilient optimism in this equity market, Lisa. You just can't beat it down.
It's not rock solid. I mean, honestly,
is it not?
They're
All-time highs. You just
all-time highs, but they're
bring it down.
Still. No, you can't bring it down.
You just can't. It's a struggle. I'm with you. It's fragile. It's an uncomfortable all-time high.
It's an
uncomfortable confidence.
Guys,
good. I like
does
that.
that work?
Thank you.
Is that
Lisa,
better?
you're driving me nuts. Come on. Year to date,
I'm calling Dr.
NASDAQ
Phil.
up 18%, SPX up 22%, Dow Jones up 17%. It's just not rock solid.
Okay, fine. You can mock it on the headline numbers, but if you look under the cover, there are winners and there are losers, and there have been some significant laggards, and that's interesting. And I see you covering your face. I still think it's interesting and important to point out.
It's been tough out there if you've not been long this equity market.
Well, yeah.
Although Tom's not been long either, so I mean, who knows? Don't you need to do a role reverse?
I'm looking for an
come
entry
on.
point.
Futures up 0.4% this Tuesday morning. Good morning to you all. All-time highs in the equity market. A ton of earnings through the week. Looking forward to covering them with you. From New York, this is Bloomberg. All-time highs into Tuesday from New York City this morning. Good morning. Equity futures up another 18, advancing 0.4% on the Nasdaq 100. We gapped lower from September 7th. Then we gapped higher. We're 1% away from taking out that September 7th high. In a Russell, the small caps, they advanced a third of 1%. That's the equity picture. Ton of earnings through the week. Big tech after the close. What do we got? Microsoft, got Google as well. Switch up the board and get to Tesla and get to Facebook. Congratulations, Elon Musk. Intraday, this is not pre-market here, this is intraday yesterday, up 12.66% on Tesla. What a move off the back of a $4.2 billion deal, Tom. What a move. A $1 trillion company now. $4.2 billion deals at over $100 billion in market cap. Tom, as Lisa pointed out, and we've talked about several times, we have a junk-rated credit with a $1 trillion market cap in the equity market.
And they got to go out and build the stuff as well and think of the competitors that will come in. That's all the doom and gloom. The reality is everybody's on board. As I said, it was accelerated yesterday, John.
That's the Tesla story at the close yesterday.
Yeah.
Here's a story right now in the bond market, 2s, 10s and 30s. 10s right now 162.38. Highs of the year were pushing 180. End of March at about 177. At that point, the 5s, 30s curve was around 160 basis points. Right now, Tom, it's about 80, 90 basis points, and that's the change. Yields might have picked up on 10s, pushing out where we were in the first quarter at the back end of March this year, Tom, but the curve's gone the other way because of that lift at the front end and through the belly. We're talking about rate hikes now in a way we weren't at the start of the year, and that's the difference.
Yeah, Crescenzi was brilliant on that. And, John, I'm just noticing it for the first time because I usually ignore the real yield, but negative 1.04, I mean, that's going the wrong way for the optimists.
The recent move, Tom, all about inflation. Right now, 30s, 2.07%. You usually ignore me too. Down on the long end, Tom, by about a basis point on 30s this morning. Back to you.
Thank you, John.
Anytime.
Good. Lisa, you want to jump in here?
No, I think that you guys have done a great job.
We've done a great job.
Let's go to Andrew.
Warming up the morning. Andrew Sliman joins us right now, Senior Portfolio Manager at Morgan Stanley. Andrew, I love this idea of watch the internals. That's jargon. What are internals to a guy like you?
Well, look, this summer we had this, kind of gross slowdown and people were kind of very doomsday, but the 10-year bottomed early August and has been going up ever since. The yield curve bottomed early August, has started to go up, and that was followed by the more economically sensitive stocks starting to outperform the defensives. Utilities was one of the worst performing sectors. So the market has been screaming that the economy was not going to roll over for quite a while now, and it feels as though people are waking up to it. So the call of a big correction, I thought, was completely misguided because the internals were saying, no, economy was strengthening. And my experience is, a big correction occurs with a growth scare, not a growth acceleration.
I've been watching revenues. Gina Martin Adams taught me that. Andrew, I'm looking at 3M coming out moments ago. You and I know 3M has been a challenging exercise for the last decade, yet there I'm seeing revenue growth of 9%, modeled out to 10%. I mean, the fact is it's revenue growth higher than nominal GDP. What does that signal to you?
Strength. It's strong. And look, I was on a call last night and this, someone said, it's all prop. The market's only up because of the Fed, blah, blah, blah. And I said, wait, time out.
Thank you.
The market is up 21%.
Right.
But keep in mind, the estimate revisions by Wall Street has revised up the S&P earnings estimates this year by 21%.
Lisa, so are you taking notes?
Thank you. I appreciate it, Tom. He also said that the Bears are running out of time. Carry on.
The Bears are running out of time. I think next year is going to be a tougher year, but the market's going to be higher than this by year end.
Well, let's talk about next year. What are we underappreciating going into year end that you think will actually start to go the other way next year?
Well, the third year coming out of bear market is always a tougher year. You look back to, if you consider 2011 was a flat year. 2002 was up 4%. The market starts to worry about the Fed moving in the other direction. And so the third year is a tough year. And I think you get a combination of discussion of the Fed raising rates plus fiscal policy is moving in the wrong direction also. I think in other words, higher taxes, that's reducing liquidity. I don't think it's going to be a doomsday year, but I think it will be a mid-single-digit year. But before that, we could have quite a good move from here into year end.
Andrew, you just said higher taxes. Is that still in your base case? Your underpinning assumption for next year in your outlook that we get higher taxes?
Correct. The only question in my mind is some of that embedded in earnings estimates already? Because next year's estimates have not gone up as much as this year's. Usually when a company beats numbers, analysts raises this year and next year by the magnitude. There's been a lag into next year. So I do think there's a risk that it's not as bad as possible. But at the end of the day, it's just lower liquidity. Fiscal monetarily is not as good for our equities. It's not a disaster, but it's just not going to be as good as this year. So naturally, last year was a monster year. This year is a great year, and next year will be a tougher year.
All right, so Andrew, what do you do as an investor with this? I mean, do you just lean into risk, lean into cyclicals, lean into the trades that have been working best, and just wait for signals that perhaps it's time to shift?
Well, I think, Jonathan talked about the yield curve, but the 2 to 10 year is only 120, it's only in the, it's less than 150 basis points. And if you look back at every recession at post a yield curve inversion, we get to about 250, 300 over. And in that environment where yield curve is continuing to steepen, you want to own financials. You want to own value stocks. They work. They have not repriced back to where they were. So I think there's a very big opportunity in those stocks. They're working. It's great, but it's not over yet. So I wouldn't fade them. I wouldn't sell them yet. Energy is a different animal because you have something called OPEC and so forth, controlling energy prices. But I do think the value trade is not over. Now, that's in the U.S. I've got very strong opinions on other places in the world. Tom, you mentioned real yields. You want to look at real yields going the wrong way. Look at Europe. I mean, nominal is up, but the inflation is up more.
Are you saying that you actually are bearish on Europe right now after a story that really supported that?
Correct. Because real yields are going down. Rates are going up, but not as much as inflation, break evens. So it tells me that there's a higher chance of stagflation in Europe than there is in the U.S. So I'd rather own cyclical stocks, value stocks in the U.S., and this has been our position all year long, than in Europe. And at the end of the day, go look at how the XLF is done. That's the financial ETF here versus the EUFN, which is the bank financial in Europe. It's doubled the return. So to me, I'd rather bet on cyclical recovery in the U.S. than on Europe.
Andrew, the language changes, but it's the same. Somebody's on the bid, somebody's on the ask. The vogue is gamma squeeze. Gamma, folks, is a Greek letter for an accelerative second derivative movement, in this case, up, 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 typically. Is that just a new phrase for catharsis this October?
I'm not smart enough to figure all that out, Tom.
Are we just enjoying some form of Tesla catharsis where up we go, boom, and we're setting ourselves up for the big drop?
Well, look, there are stocks that are kind of the love stocks, but I'm very wary to paint the market in that picture because, look, if I look at my portfolio of stocks, almost every company in our portfolio so far has beaten and raised numbers. So I think the earnings fundamentals are, validating this rally. Now you can point to specific stocks like you did and say that, well, it's a crazy market, and that's true. But don't, don't miss out on the bigger picture here. His fundamentals are damn good.
And John, Lisa was really, Liz Ann Saunders was really, really good on that. So was Lisa as well. Tesla's not the market.
Sometimes I just think that Andrew and Lisa are just speaking to each other.
They are.
You think so?
Even though he's meant to be talking to all of us, it's just the two of them. Andrew, thank you, sir. As always, Andrew Slewin there of Morgan Stanley. Great work, buddy. 3M. There's another stock to have a look at, up by 2.2% in the pre-market. Just want to work through a little bit of this with you. This is what they had seen previously for full-year sales. They had seen them up 7 to 10%. Now it's 9 to 10%. For full-year EPS, a little tweak here, 970 to 990 from 970 to 1010. So that comes in at the top end just a little bit. And Tom, here's the headline. They see raw material and logistic headwinds of 80 to 90 cents a share. Just getting an idea of how much of a headwind that still is for some of these companies.
Yeah, it is as well. Eli Lilly out as well. Completely different area, John. But, again, this is like Gina Martin Adams territory. Things are constructive. It's terrible. Futures are up 17.
Well, Thomas, you've said repeatedly, what's your slogan of the year, your phrase of the year? Companies adapt. Companies adapt. You've kept saying it, and companies continue, Tom, to adapt.
Yeah, that's a big miss. John, what's so important here, and I give our team great credit on this, like we should actually talk about earnings of boring companies because it actually matters. But John, the media is so short-term in its view on equity performance, and I'm not saying we're drawing it out to a 3 or 5 year vision, but it would be nice to get into the summer of next year.
Well, let's separate the stock from the business, Tom. Separate the equity market from the business and talk about the business a little bit more. Lisa, we talked about the resilience of this market. We can get into that another time. Let's talk about the resilience of corporate America. That's been impressive.
The idea that they can pass along a lot of the price hikes to consumers and consumers will keep buying. The idea that margins have really held in much better than expected, even as you see billion-dollar charges for higher material costs. However, the issue that I have is, and one of the big question marks going into next year, and I got to say, Tom, you're going to make fun of me, but if they pass along higher wages, at what point does this bleed into persistent transitory, or whatever you want to call it, that's going to lead to a new regime?
You know what they say when you inject the word but but or however, everything you'd said previously doesn't count
Chicago
anymore.
thing.
What does it not
It's
count?
not balanced, Lisa. Once you say but or however, everything before just doesn't really work anymore.
Well, I think
you know that anyway. Lisa Abramowicz, Tom Keene, Jonathan Ferro. Equity futures up 17, advancing 0.4%. It is a big day for earnings, big week too. I think we get about 30% of S&P 500 companies reporting earnings this week. From New York City, this is Bloomberg.
With the first word news, I'm Laura Wright. China has told the billionaire founder of Evergrande to use his personal wealth to alleviate the property developer's deepening debt crisis. Bloomberg's learned that Beijing's directive came after Evergrande missed an initial September 23rd deadline for a coupon payment. The demand adds to signs that China is reluctant to orchestrate a government rescue of the company. UBS has joined its Wall Street rivals with a third-quarter profit surge. The Swiss lender's wealth management fees soared the most in 3 years. Like a number of banks, UBS is looking to Asia to boost profits.
I'm strategically football in China. Absolutely. Who can't be, right? We know the country very well. We're very successful in the country, both in the onshore business and the offshore business. We have a very good combination of businesses in the wealth, IB, and asset management business, and we plan to invest more.
Meanwhile, UBS is starting a digital wealth manager in the US. It's targeting customers with less than $2 million in assets. President Biden will probably be unable to come up with one of his key campaign promises to roll back Donald Trump's 2017 tax cuts. There is unyielding resistance among even some of the president's own party to raise taxes. The president already has acknowledged there aren't enough votes to raise the 21% corporate tax rate. UPS posted third-quarter profit, but we'll get to the end of this flash now. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
The projections that cases would go down are coming true, and we hope that that'll continue. And, you know, that's what the projections show. The question is how low they'll go, and that will depend really on how many people get vaccinated.
Good to catch up with Joshua Sharfstein there, the Vice Dean at Johns Hopkins Bloomberg School of Public Health. From New York City this morning, good morning. Tom Keene, Lisa Abramowicz and Jonathan Ferro. The earnings this morning, so far, so good. Your equity market is still positive at 0.4%. After the close later, Microsoft and Google. In the bond market, 162.55, yields unchanged. Crude basically unchanged now too, down almost 0.1%, Tom, at 83.68. And euro dollar not doing much. Stronger euro, just euro dollar positive 0.1% to 116.23.
You have to, John, and what you have to do here, and we're going to continue to cover this. I love what I see, again, up 0.6% on the NASDAQ, is, John, you got to do the math. We're going to do that now with Amish Adalja on this important day where the government decides should the little kids be vaccinated. Amish, we're going to do, and I know you've had a sleepless moment, but you and I are going to do the math. Myocarditis off second shot, the number I'm working with needs scientific notation, 1.46 times 10 to the minus 3. Okay, fine. The percentage numbers here, does the public understand how small the likelihood is of a frightening myocarditis off the second dose?
It's unclear. I do think that sometimes when we talk with numbers like that, the general public, it goes over their head or they don't really concretize it, because what they think about is they heard some anecdote from somebody who had a kid that had myocarditis, and that's to them, that's 100%. So sometimes it's very hard to teach people how to risk calculate because they're not able to, and they're very swayed by anecdote.
John,
so what we really do is show them how rare it is.
I mean, John, this is critical, and this has to do with social media. I'm sorry, social media doesn't do the math.
Well, Tom, even when I hear from health officials, though, directly, I'm still confused as to what I need to do. Amish, let's talk about that now, Doctor. I was fully vaccinated in and around sometime in May, let's say, and I'm trying to work out how protected I still am from this virus. Do we have any idea Does it vary from person to person? Do these vaccines only last 6 months? Doctor, what are we learning about that?
Well, it does vary from person to person, but you have to take a step back and ask, what do you want the vaccine to protect you from? Do you want it to protect you from serious disease, hospitalization, and death? Or do you want it to protect you from every breakthrough infection, even if it's mild and doesn't even require a doctor's visit? When it comes to the former, serious disease, hospitalization, and death, unless you are above the age of 65, immunocompromised, have some high-risk condition, your vaccine is working really, really well for you. For breakthrough infections, I don't think that these first-generation vaccines should be used to kind of chase breakthrough infections and kind of kick them down the road, because we don't know how durable that response is, and we might be doing this again in another 6 months. So I don't think that's a good use of the boosters. But for those above the age of 65, those with high-risk conditions, and those who got the J&J vaccine, those individuals should get an additional dose.
Dr. Adalja, the implication here is significant that you don't think that it is worth trying to prevent breakthrough infections for people who are vaccinated who do not have pre-existing health conditions. Is that what you're saying, even though those people could potentially transmit the virus in a social setting? This is not something that should even be tracked if they're not going to get hospitalized, if they're not going to die from it?
It's unclear how well it actually prevents against breakthrough infection. We have some limited data that shows, yes, for some period of time, after that vaccination, you may be less likely to get a breakthrough. However, we don't know how durable that is. And other individuals, including Paul Offit, who's on the FDA committee, said this is like akin to kind of rolling a boulder up a hill and only have it to roll back down again. So I don't think that's the best strategy, because the virus isn't going anywhere. Everybody is going to get COVID-19. Hopefully it's a breakthrough infection and not and mild for them. And I think that's what we have to do with these first-generation vaccines. There may be vaccines down the line that induce more immunity in your nose, which may be more beneficial for preventing breakthrough infections. But I don't think that these vaccines are really going to be good for chasing breakthroughs in mild people. And we don't actually know how contagious these individuals are. And clearly, if you've got symptoms, you should be tested, and you should isolate and not expose yourself to others. But I don't think that this is something that's driving cases across the country. This isn't what's causing the problem. The 70-something thousand cases we have every day in the United States now are not being driven by breakthrough infections. They're being driven by unvaccinated individuals.
Dr. Adalja, you've come on this show repeatedly over the past few weeks and frankly even a couple of months and said it is time to transition to a new reality where COVID is just present and we have to live with it. And I wonder how controversial this is, how much pushback you get from colleagues, how heated your conversations are, as so many people, whether it's China looking for a zero COVID policy or even here in the U.S., it still is really trying to adhere to pandemic-era policies.
I came out and said that this was going to be the fifth seasonal coronavirus back in February of 2020, and that we had to start thinking about it then. I had a lot of pushback early on, but now I think people are coming to the conclusion that really was something that wasn't even questionable based on the fact that this is a respiratory virus with an animal host that spreads efficiently, that this is going to be endemic. So that pushback is lessening, but there are people that are having a hard time adjusting to a new world where COVID-19 is always going to be there, that there's going to be COVID-19 cases 50 years from now. And I think that's because people weren't told that ahead of time. And public health really went on this abstinence-only approach where never do this, don't do this, this is always going to be risky, and didn't teach people how to risk calculate to adjust their lives or recalibrate their lives with the fact that COVID-19 is going to be a respiratory virus that we deal with year in and year out, and you've got to learn how to cope with it. You've got to learn how to make good choices, and the best way to do that is to be vaccinated, so COVID-19 is not a problem for you.
Doctor, do you think, you mentioned public health policy, and I'd like to finish here with you, do you think there has been a risk, particularly over the last year, that a lot of public health officials now are conflating the science with what they'd like to see in social science, behavioral psychology? Do you think that's where there's some confusion at the moment?
I definitely think that people sort of took their values, whatever they might have been, and kind of applied them to COVID-19 policy. And that's, I think, what caused all the acrimony over masks, over vaccines, people protesting. All of that really has to do with the way society kind of viewed COVID-19 and how they viewed it through the lens of whatever tribe they were in. And that was how they viewed it, not looking at the science, but what did their tribe think, whether that was the tribe on the right or the tribe on the left. And nobody was actually saying, what's the actual data show here? How can we do this safely? We all have to kind of live with this virus. What's the best way to do it? But I think we live in an increasingly tribal society, and people kind of want to know what their collective thinks, and then that's what they think, and then it becomes difficult for anybody trying to actually break through those bubbles.
We expect politicians in Washington to be politicians. Doctor, was this a failure of institutions, groups like the CDC?
I do think that when you look at what happened with COVID-19, this is a failure of government at the federal level, the state level, the local level, even the school district level. And I do think that the CDC had a lot of failures. You can't really blame them because they've been captive to politicians. They were captive to the Trump administration, where we saw lots of political meddling going on, where the CDC director was basically bound and gagged and put into a trunk. And the same thing, I think, is happening to a lesser degree, but still happening during the Biden administration, where we're always wondering, did the CDC director overrule that advisory group because she herself believed the science was a certain way against what her advisory committee said, or did she try to make Biden's promise to give boosters to everybody whole? So those are questions that we have, and I do think the CDC is something that's been damaged by this pandemic.
Doctor, that is a problem and a conversation you and I and all the rest of us need to continue. Amish Adalja there of Johns Hopkins. From New York City this morning, good morning. Tom Keene, Lisa Abramowicz and Jonathan Ferro, all-time highs in the equity market. Futures positive, 0.2%, up another 0.4%, rather, up 20 points on the session. And the earnings this morning are looking okay. From New York, this is Bloomberg.
Powell and the Fed are increasingly open to the prospect of perhaps a quicker hiking and tightening cycle.
The market has repriced the hiking cycle significantly.
The market's been very quick to price out interest rate hikes by the Fed in the middle of next year.
From a Fed's perspective, the fact that the terminal rate is not rising gives them less room to hike.
We don't think that they'll actually be raising rates until 2023.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This is not the earnings season the Bears were hoping for. From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market up another 0.4%. TK, the earnings so far so good.
It's the way it's up, and the VIX under 15 is a huge, huge deal. John, there's a reaffirmation here today that's very different than 5 days ago, 10 days ago. Again, more earnings coming in as Gina Martin-Adams and the others of the bulls that we've talked to have said, you know what? The sum total of the stories, earnings and revenues up.
A lot still to come, though, Tom. The big tech players after the bow, Microsoft, Google, then on to Apple to end the month, Tom. Apple was in the news because of the supply chain story, a struggle to meet demand. And we thought that would really define this quarter. Tom, so far it hasn't. Margins have held up, and that's really been the story, not just of the last couple of weeks, but the story of the year so far.
I'd go away from tech, and I think the PowerPoint, it's a very CARP kind of PowerPoint, something that you'd see from Danaher years ago, and buried in it, you see the reality. GE Aviation, their fleet is down 18%. That's their calculation. They're parked on the ground. But away from that, is the idea of pretty good margins, even with flat revenues. Is that tech? No, but it's good.
You see what you get here, Lisa? You get commentary on the numbers and commentary of the PowerPoint of the earnings release. TK, sure. You are the only man I know who gives commentary and critiques the PowerPoint
That's what
presentation.
you do. This is really important. Stop the show. This
the show
is
stop.
really,
Go.
really
Go.
Next 2 hours. Go.
Is the way the media looks at the earnings as a parlor game, John, is different than the way Global Wall Street looks at it, which is, you know what? You got to listen to the conference call. You got to go into the data. Our guest coming up here, that's exactly what she does.
Who has the best PowerPoint, Lisa Abramowicz? Never mind the earnings. Who's got the best PowerPoint?
I'm going to let Tom be the absolute expert on PowerPoint commentary, and I'll shift gears to really just go to where you started. Basically, it is a bad morning for the Bears. That you can say that again and again throughout the year. I do wonder how much this is a story, as you've both been saying, of companies adapting, but the idea of an economy that still will slow down, and that this is actually still Goldilocks for these companies. And I do wonder about those cautionary signals from a flattening yield curve, and the idea that we have an even deeper negative real yield actually giving fuel to this, even though it sort of sends a negative implication to the economy.
If inflation comes down too, with that decelerating growth, we need inflation to come down too to keep this where it is so far. Let's get to the price action this Tuesday. All-time highs coming into today. Equity futures adding a little bit of weight to the recent rally, up about 0.5%, call it 0.4% higher on the S&P, advancing 19 points. In a bond market, just a little bit of stability here, though, TK. Next week is where it's at. A Fed decision on the Wednesday, then on to payrolls Friday. Your 10 is 162.38.
Yeah, the payrolls is going to be interesting, and I don't know which is going to be more important here, but John, John, I also would point out ECB is not a small issue with the Weidmann resignation. I mean, there's a stew out there, if you will, and I guess we're all predicting it, but we always get it wrong.
And the Bank of England too, the ECB, 2 days away. To paraphrase Kit Jukes, Lisa, euro dollar a snooze fest, 116.23.
Yeah, and it has been actually shockingly resilient considering all of the wins on both sides. You mentioned earlier, John, the idea of if inflation comes down, then we could have a potential Goldilocks scenario for these companies. The interesting thing is we are seeing prices continue to rise. 9 a.m. we get the home price index, probably expected to rise 20%, a record year over year. Yet people are still buying. 10 a.m. we get U.S. September new home sales. The expectation is for it to actually increase, despite the fact that prices are so high. We're also going to be getting U.S. Conference Board consumer confidence numbers. The expectation is for confidence to wane just a touch, but still remain relatively high again. Even though inflationary headwinds are there, people are still buying, people still can get a job, and that has kept things afloat. Today, an FDA panel is meeting to discuss vaccinations for 5 to 11-year-olds. Key question is, what will the uptake be? What will the messaging be that this is safe, especially considering the fact that less than half, fewer than half of 12 to 17-year-olds have been vaccinated so far? This is key in terms of public sentiment and public support. And after market, we get earnings from Alphabet, Microsoft, Twitter. This is going to be very different in terms of the individual stories. From Alphabet, Google, John, and Microsoft, it will be a cloud story. For Twitter, it'll be an advertising revenue story and getting the eyeballs at a time when it is incredibly competitive.
The close will have that here at 4 p.m. Look for that across all of our platforms. Right now, this is an incredibly important interview for 2022 and indeed 2025. U.S. on fire, and again, the bears have been vanquished here, no question about that. But a recurring theme that we have on surveillance is look to Asia and look to the true growth there. Gabriela Santos with JP Morgan joins us, their global market strategist. Gabriela, I love how your essay dovetails into what I'm seeing in the new Foreign Affairs magazine, which is China, and you define a new China. What is the new China?
That's right, Tom. And in a lot of our conversations with investors, China keeps coming up time and again as really an area of growth in portfolios. And I think it's much more about a conversation about Chinese markets more so than China's economy going forward. I see the new China really being about one that stresses the quality over the quantity of growth, that also prioritizes other objectives in addition to growth alone, such as reducing inequality and energy transition, a development of capital markets, and also a China that has new areas of emphasis. So this year has been all about the areas of pressure in the new China, but there are also areas of emphasis like domestic consumption, technological infrastructure, and the energy transition. And it's interesting, our investors still believe China is investable and are looking at this point in time as an opportunity to build that allocation to China over time.
Is there somewhat capitalism, or at least their experiment? Is it endogenous more so to China, or does it redound out across the Pacific Rim and all of Asia?
I think we do have to remember China has a very particular political and economic system, and we see that at play this year. When China does decide to pivot and to do reforms and regulations, it does so extremely quickly, and that is a feature of China. It does lead to these moments of volatility. We see these 30+% corrections every 3 years or so in China. It's a feature of investing there. It does come with higher volatility, about double the volatility for Chinese equities versus the S&P 500. But you do get other benefits. You get the potential for higher revenue growth in these new sectors of emphasis, and you get extremely good diversification benefits. It's working against you this year. China's down 11%, while EMX China is up 10%, but it can also work in your favor like it did last year. So net, we still find it helps to boost risk-adjusted returns, and that's very unique to the China onshore market.
Gabrielle, are you concerned at all about the political ramifications in the United States toward investing in China? The idea here that there is a changed relationship between the two nations, and that if companies or even investors move into China, they could be susceptible to risk at home in terms of regulation.
So we do see in surveys in the US, as well as actually in a lot of countries around the world, this increase in unfavorable opinions towards China. And I think that's honestly a feature of the next century, this competition between China and the rest of the world. What we talk to our investors about is that whatever you may think or not about China and its political system, you can't ignore it. You can't ignore it in terms of the size of its economy, the size of its markets, with the second largest equity and bond markets. And you also can't ignore it in terms of the risk-adjusted benefits it can provide portfolios. So maybe an investor decides that investing in China is not for them. But I think as a fiduciary, investors need to prove that they've thought out the benefits that they're leaving on the table and that they've well documented the reasons why.
Meanwhile, Gabriela, the question of what happens in China directly bleeds into the supply chain disruptions that we continue to see. How are you sort of gauging the activity level there with when we'll start to see some of the inflationary pressures from supply chain disruptions perhaps start to abate a little bit more?
So we've clearly seen a deceleration in China in the third quarter, 4.9% GDP, down from 7.9. That deceleration can continue a bit longer in the fourth quarter. Part of it is related to the pandemic. China's the only country that continues with this zero tolerance approach to COVID. So localized restrictions are still going on in China, and that can affect some production and some consumption of services. But more than that, I think we're learning that this deceleration in China is a feature, not a bug of the new China. It is about lower quantity growth, much more about quality. So structurally, we'll continue to see a decline in things like property, infrastructure, low-end manufacturing, energy-intensive industry. The floor on Chinese growth is much, much lower, and I think that's something that investors need to internalize and adjust, lower their expectations, and then we can move on and focus on the opportunities.
Gabriela Santos, thank you so much with JP Morgan this morning. A really interesting idea on the new China. And of course, folks, we're seeing a real percolation here of thinking about China, not only to COP26, but also out into 2022. John, we've been remiss. We haven't talked about UBS and Swiss banking. I guess it's better, and I guess the headlines are better. But when everything is said and done, it's not American banking, is it?
No, it's not. And they've still got their problems, Tom. But what we've seen so far out of Europe, including Barclays, pretty much what we saw out of the United States. Equity trading from Barclays last week, Tom, fantastic. Likewise, in the US, it's been a decent quarter for the banks. Can they repeat the act on the IB side of things through next year, Tom? I guess that's the question.
And how are they going to compete with the U.S. banks coming over and looking at retail Europe?
The battle for talent as well.
Yeah.
Compete with that. Flexible working hours, Lisa, how many times we heard that from the European players?
Yeah, exactly.
You can stay at home.
Yeah.
It's okay.
And we don't have to pay for real estate.
You can stay at home. It's a massive week for big tech. Microsoft, Alphabet, Twitter after the close. Alphabet year to date up 57%. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. The US and Chinese governments have made some incremental progress in their economic and trade negotiations. Treasury Secretary Janet Yellen and China's Vice Premier Liu He held their second call in around 4 months. Beijing described the conversation as pragmatic, candid and constructive. China has repeatedly said the US should lift tariffs on Chinese exports imposed during the Trump administration. Senate Democrats have moved closer to an agreement on President Biden's economic agenda. Senator Joe Manchin expressed optimism there could be a deal this week. He's been pushing to shrink the size of the social spending package. Still, some House lawmakers raised doubts about the terms of the deal being discussed. Hong Kong will soon end most of the quarantine exemptions for overseas and mainland travelers. The city is under pressure from the Chinese government to tighten up what is already one of the world's strictest coronavirus containment programs. Hong Kong's goal is to eventually reopen the border with mainland China. General Electric has reported third quarter earnings that beat estimates. The CEO said orders grew, margins expanded, and the aviation unit is showing continued signs of recovery. GE expects that 2021 revenue will be flat year over year versus earlier expectations of a low single-digit increase. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
tired of trickle down. Trickle down hadn't worked so much for the last 15 years. These bills are going to change the lives of millions of people in areas and hundreds of millions of people across the country. When we make these investments, there's going to be no stopping America. We will own the future.
The President of the United States from New York City this morning. Good morning. Tom Keene, Lisa Abramowicz and Jonathan Ferro. All-time highs into Tuesday in the equity market. We add some weight to the rally. The S&P 500 advancing once again up 20, advancing 0.4%. In the bond market, yields in a basis point, 162. A bit of stability in the past 24 hours, going into a critical week for the Federal Reserve. And not about tapering. It's about whether they actually push back aggressively against what we've priced into the front end and through the belly of this curve. Tom, higher interest rates. Very little pushback from Chairman Powell on Friday.
I get it, John, and I get the Fed speak as well, but are they also having to calculate in pretty good GDP growth, witness the corporate earnings season?
We understand, though, Tom, it's not about GDP right now, is it? It's about inflation and the trajectory for inflation. And I just wonder, Tom, how the language evolves. Transitory for longer doesn't cut it. You can say that you think the factors underpinning higher inflation will fade. You've also got to convince others, though, that those prices, Tom, aren't broadening out. Those higher prices aren't going beyond those temporary factors connected to reopening.
I went back and forth with Dr. Alarian on this yesterday. I mean, I'm sorry. We have to wait for the data. John,
well, we know what Mohammed thinks, Tom.
Yeah, well,
if the Fed
he's got some real worry.
He thinks if the Fed sits this out, they're making a massive mistake. I can find another 10 people who thinks the other thing, Tom, the opposite. And that's where we're at right now.
That's what makes it go. Where are we in Washington right now? We're going to stop the show and get away from the blather of the moment. We can do that with Anne-Marie Horder, Bloomberg Washington correspondent. Pro tip, Anne-Marie, and you know this, watch Richard Neal of Massachusetts. Here's a guy who lost both his parents in his childhood. He literally went to college on government checks, getting by, and then he built a political career into being the most powerful voice on our ways and our means. What is Richard Neal going to bring to the debate?
Well, when you keep talking to Richard Neal, especially as the Senate Finance Committee is pushing their new way of this revenue stream for the social spending package, he's saying that his package, what their committee has come up with, the House Ways and Means Committee, which he's chair, looks better every single day. He says that rates are advertised. Rates are black and white. They are in the public eye. He says that this is a way that they could be able to support the revenue stream. It has wide public support, especially when you look at the corporate tax rate. And he thinks that this plan is the plan that in the end will continue to go ahead, because also he points to the fact that what is happening now in the Senate Finance Committee in this draft, which, by the way, we have not seen just yet, is that could be open to a lot of constitutional challenges in the court. And there's still a lot of questions given the fact that this has never been tested anywhere in the world, a so-called wealth tax. So he thinks that his committee's plan is looking better and better every single day.
Okay, this is important. I'm not sure if there's any billionaires in the 1st Congressional District of the Commonwealth, except for the rich guys up by Tanglewood for 6 weeks in the summer. But Richard Neal has to talk to Chicopee. He's got to talk to Lenox. He's got to talk to Springfield and, you know, the people sending their kids to Cathedral High School. Great. My father went there. I know the terrain. Anne-Marie, how does he and Pelosi and Schumer and the liberals and the moderates, how do they speak to the 1st District and not the fancy people?
When they speak to the 1st District, Tom, and not the fancy people, it's going to be about making sure that those individuals, and the president has made this time and time again, that are making less than $400,000 a year will not see a single cent of their taxes rise. This is a slogan that you hear constantly from everyone of the Democratic Party, that they should pay their fair share. But now, when you start looking a little bit more into it, what does actually pay your fair share mean? Who are they targeting? With the billionaires tax, it's about 700 people or so, give or take. When you have something like an income tax rate that's higher, above $400,000, then you're looking at a wider swath of individuals in America. But we should make clear, it is not clear to anyone yet exactly how they are going to approach this. We know that Kyrsten Sinema is not on board with the raising of the corporate tax rate or the income tax rate, which is why they are discussing this billionaire's wealth tax, because they need to figure out how they're going to pay for this. So I'm still a bit unclear on which direction they are going to go, one, and then the fact that they think they can wrap this up in 48 hours before the president boards Air Force One to head over to Rome. Mind-boggling. I don't see how they do it.
Anne-Marie, when it comes to ordinary income in America, this tax system is very, very progressive already. When it comes to ordinary individual income, it's highly progressive. And I think you can make the argument that most people receiving ordinary income are paying their fair share. What's got lost is the corporate tax rate. And Anne-Marie, I find it amazing. Do we face the very real prospect that we won't get a corporate tax hike under this government?
This is what many are talking about. The fact that you can have this government not rewind the Trump era tax cuts. This is something that so many of them campaign upon, that Kyrsten Sinema voted against those Trump era tax cuts. There is potential that some of that tax code will live on. There's one thing that Richard Neal did speak about, the chair of the House Ways and Means, that there does seem to be at least a coalescing around, is a 15% minimum corporate book tax for corporation. And this would also come in line with Treasury Secretary Janet Yellen has been pushing for in terms of the OECD around the world. So potentially that's something that would likely happen, but you could see remnants of the Trump-era tax cuts sticking through this democratically led House, Senate, and White House.
Anne-Marie, just to fast forward a little bit till next week, if what you say is correct and they don't get anything done before Joe Biden gets on that plane to the COPD, what does that mean for the Virginia gubernatorial races?
Well, he's going to be campaigning in Virginia this evening with Terry McAuliffe, which has been a bit of a fraught relationship. Remember, Terry McAuliffe was saying, we know that Joe Biden isn't doing well, and he was trying to distance himself. Now it does seem like he needs him. That polls for Virginia are neck and neck. What Virginia would like is at least to get somewhere on hard infrastructure, a vote on hard infrastructure. And a big question mark right now in Washington, Lisa, is whether or not the progressives are willing to vote for hard infrastructure if there is at least a framework or a meeting of the minds of what reconciliation will look like. And there's still a number of questions on that: climate, paid family leave, and a top line figure. But what we hear constantly, time and time again from progressives, is that they will not vote for hard infrastructure unless there is a vote on reconciliation, not a framework, a vote. A vote on reconciliation is weeks or potentially months away.
Anne-Marie Horden, AMH, down in D.C. TK, let's try and make it.
AMH.
I think it's sticking. Better than AOC.
Is, you know,
just for Anne-Marie anyway. Just in general. Not she's better than AOC. I want to avoid that trouble. She was confused with AOC.
You're digging yourself into trouble.
I know, Tom. Let's make it very simple when it comes to taxes. You can tax incomes, ordinary income. You can tax assets, realised gains or unrealised gains. Much easier to tax realised gains. Or you can tax transactions. Tom, they've got to find a way of going after taxes beyond just ordinary income. Ordinary income is the easiest thing to go after. But I think at this stage, at what point, Tom, is 40% enough? Is 50% enough? What's the line in the sand here?
Here's the line in the sand. Add up your combined taxes. The politicians love to talk about individual taxes, and what we do is this one, that one, that one. Sum them all up, John.
Go after transaction taxes, not a regressive sales tax. If I want to buy a Bentley, charge them 25%. Private jet, 50%. Whatever. Ordinary income, it's got to stop, Tom. It's got to stop.
I'm not paying that on the Bentley.
Some people very unhappy about the things I was listing, Tom, to tax. I'll make sure there's exemptions for you, TK. A lot of people in your boat worried about the price of a Bentley if you had to pay too much on top. I know. Equity futures up 20 on the S&P, advancing 0.4%. On the Nasdaq, up about 0.6%. A lift here after the close. About 10% of the index reports in two names. Just two names: Microsoft and Alphabet. Switch up the board and get to the bond market. 2s, 10s, 30s. The shape of your bond yield curve looks like this. Your 10-year 161.85 in about a basis point. A 30-year down 2 to 2.06%. And a bit of a snooze into next week. Next week, you can wake up again. A Federal Reserve decision on the Wednesday. And on the Friday, you get payrolls Friday. In between, Tom, a Bank of England decision that I'm told is live. Governor Bailey, look out. I'm not sure if he's aware how live that meeting is. Hugh Pill, his chief economist, Tom, was the one that suggested that. But the rate hike debate is at the epicenter of what's happening in the belly of the curve. Let me just show you 5-year yields over the last year.
Please.
Tom, at the start of the year, we thought the Federal Reserve would sit this out. We thought they would sit this out. And what you had was a positive growth shock. Never mind the supply side story that's dominated much of the year. At the start of the year, it was a positive growth shock. Just the idea the Fed would sit it out. Growth expectations were higher. Inflation expectations were higher. And the belly of the curve and the front end were really anchored. Then something's changed, Tom, as this year has grown older. We've started to think a lot more about higher interest rates and a tightening cycle. And that's what the 5-year has picked up on. 117.45, Tom, on fives. When we started the year, look where we were. Below 50 basis points, TK, in and around 0.5%. That's a big change.
We've moved, but are we back to where there's some real angst out there? Even with the break-evens, I'm not sure we're back to angst.
I don't think we are yet, but just a little bit of a test building for the Federal Reserve going into next week. They told us
You're
tapering
solid, John. I
wasn't
like it.
tightening. There was a divide
job.
between the taper decision and higher interest rates, and now this market's not so sure. This market was on side through much of this year. Not so much anymore. Your 5-year yield, 117.45. We've got some movers this morning, TK. We can do that this morning with Kaylee Lines. Kaylee, that was your cross-asset price action. Let's get to those earnings. Good morning.
Yeah, it's really all about the earnings for the equity market this morning, John. We've had a number of them rolling out over the course of the morning thus far. UPS, one of them. What's really key here is that the company lifted its margin outlook and beat on its results. It's really been able to exercise pricing power and lift prices in the face of booming e-commerce demand. So it's up about 4.5%. You also have GE higher. The key metric for GE is industrial free cash flow. That is how we gauge the progress of Larry Culp's turnaround. They raised that guidance. As a result, the share's up 1.3%. For 3M, you did get a beat in the third quarter, but they trimmed the top end of their full-year earnings outlook because of material and labor price pressures. So that stock is slightly lower, while Eli raised its guidance thanks to the success of its COVID antibody cocktail and the treatment demand for that. So it's up about 0.4%. Of course, the other earnings story out overnight was Facebook. It's really a big week for big tech. On Facebook, it's interesting. They missed on the top line in terms of both the third quarter and the guidance because of Apple's privacy rule changes in part. But they also announced a $50 billion share buyback and better users. So Facebook is up about 2%, and that is giving a lift to Twitter and Alphabet, of course, also digital advertising dependent for revenue. They both report after the bell and are higher by about 1.5%. in pre-market. And then, of course, the tech story of yesterday was Tesla, a price target lift from Adam Jonas over at Morgan Stanley, 100,000 cars ordered by Hertz. You also have Tesla Model 3 being the #1 selling car in Europe for the first time ever. So it's a $1 trillion market cap company after a 12% move yesterday, coming off a little bit, though, this morning. Shares down about 0.75% before the bell top.
Kelly, thanks so much. Coverage on that on the close here this afternoon. There'll be a lot to talk about and a lot to talk about this morning. We've really been focused on earnings, and yes, some of them are beats. There's some angst in there as well, but all in all, a constructive earnings season. So we now turn, and we've been avoiding this over the last number of days. Let's dive right into it. On Fed, on economics, and on things transitory. Thierry Weisman joins us, global interest rates and currency strategist at Macquarie. How transitory is transitory right now, Thierry? I'm worn out by the word.
I think we've got a little bit of an audio problem.
We got it here.
Muted.
Okay.
Go on, Terry. Carry on, sir.
Good morning, guys. The definition has been changing of what transitory means. I think if you had asked the median member of the Fed officials or the FOMC maybe as recently as 3 or 4 months ago, they would have told you that transitory means only 3 months of inflation. I think they saw the supply chain issues lasting, but not lasting that long. I think the definition has changed among central bankers around the world. I think they're conceding to the fact that the supply chain problems are going to last for a little longer. But maybe even beyond the supply chain problems, we've seen evidence, of course, that labor market participation rates in the U.S. are not going up past this period of pandemic emergency unemployment benefits. And I think central bankers are getting a little bit concerned that labor supply is going to be tight beyond just these 3 to 6 months. So the definition is changing. I think it means now more than just 3 months of high inflation.
Doesn't the definition changing, and whatever the new x-axis looks like, the extension of this debate out even into 2022, by your reading of history, doesn't that mean that each and every central bank has to wait for more data?
Yeah, they do. I think certainly some central banks are clearly committed to the wait and see mode. It's not universal, but I'll point to 2 important ones. Certainly the ECB is in wait and see mode. The BOJ is clearly in wait and see mode. I think they're the most dovish rhetorically of the central banks out there. And even the Bank of Canada, I think, might be in wait and see mode. You're going to see some of that this week, right? You're going to see the ECB potentially push back on the market's premise that there's going to be a rate increase at the ECB next year. And I think even the Bank of Canada is going to push back on the premise that there might be 3 rate hikes out of the Bank of Canada next year. So some central banks are trying to push back against this market view of where rates are going, i.e. trying to get the market to think more dovishly about this. The Fed is not among those central banks, though. It's in its quiet period now, but if it were in its loud period, I don't think it would be pushing back on market perceptions if the rates lift off in the U.S.
And perhaps, Terry, this is because the bears are getting extinguished basically rapidly throughout earnings season. We've been talking about this throughout the morning. The idea earnings are coming in very strong. Consumers are still spending. Is the bond market seeing a different reality, or are they just saying the Fed will come around to see what everybody else is seeing right now in equities and hike rates sooner?
I think more the latter than the former. Keep in mind, you guys were looking at the 5-year yield earlier. Is there room for it to continue to go up? Yeah, sure there is. Pre-pandemic, that yield was in the middle of the 1.5 to 2.0 range. It's still now at about 1.2. So there's clearly room for the 5-year yield, which is effectively, in the policy horizon of the Fed, or at least the visible policy horizon, to continue to go up. So yes, I think it's certainly the latter of those two options.
So how high can yields go given how much debt we have incurred? And this is sort of one of the key issues that we've been talking about all morning. What kind of cap is there on 10-year yields, on 5-year yields? What is it in your view before it becomes disruptive?
Well, I mean, the Fed is data dependent, right? And one of the key, as are many central banks around the world, and one of the key aspects of data dependency is you wait and see if, in fact, that debt burden is becoming onerous. And the way you see that is if consumers start to pull back, if companies start to pull back on business spending. So yes, I do think that, and I think this speaks to an important philosophical point out there, which is that the pandemic has left many sovereigns around the world highly indebted, but it's also left businesses a little bit more indebted in some countries and consumers a little bit more indebted in some countries. And I think in those countries where debt ratios have gone up, the U.S. is not necessarily one of them, keep in mind. Consumers have become less indebted to some extent. But in those countries in which indebtedness is high, you can make a case that the central banks will be stepping off the gas pedal earlier than otherwise. But it happens to be the case that some of those central banks are the ones that started hiking first, especially in the emerging markets. So we'll see. But I agree with the underlying tone of the premise of your question.
Terry,
debt implies lower rates eventually.
Always great to catch up, buddy.
Pleasure.
Fantastic to hear from you. Terry Wiseman there of Macquarie, just on the future, what the future might hold. Lisa, just to your point, the 2-year yield topped out in the last cycle, if we can call it that. I'm not sure if it ended in this one, started, whatever. Topped out in 2018, north of 3%. You remember what happened at the back end of 2018?
Yeah.
Back end of 2018 was when the Fed just took it too far, too quickly, and the primary market in high yield just totally shut down. So there's a lot of people out there that wonder, the Fed will back away when the equity market starts to gap lower. Okay, to some degree, it's about the credit market.
Yeah.
The primary market shut down in high yield in December 2018, and that's what made the Fed really back off. Twos then were at 3. Right now, twos are at 44 basis points. That tightening cycle hasn't even started.
And the cushion that credit investors have is much narrower this time around. And this, to me, is key because at a certain point, sovereign debt becomes competitive with corporate debt, and then those funding pressures become all the more acute. And yeah, fundamentals are looking really good because money is cheap. Money is basically free. What happens when it's not? How quickly do the fundamentals deteriorate? And so this is the reason why a lot of people are saying there is a natural cap, and that is why yields are so negative on a real basis.
For all the talk, though, Tom, 4% is your median estimate for GDP next year in America. That's a 4 handle. It's coming in a little bit, but 4.0% is the median estimate in our survey. If you want to find that on the Bloomberg ECFC Go on the Bloomberg terminal. But there it is to see, Tom, 22, 4%.
And you throw inflation on that, and maybe you've got 7%, 8% nominal GDP. I'm talking about a higher inflation that everybody's all lathered up about. And I would suggest a couple things. Corporations adjust. They sort of like that kind of mix, I would suggest. And the other thing, John, is we've got to recalibrate our glide path down to post-pandemic normal GDP. I would just suggest, and I defer to a lot of our good guests, that's out farther than it was, say, this summer.
Jan Hatzius of Goldman says second half of next year, Tom. 1.5 to 2.
Yeah,
back at it second half of next year.
I think the timeline is germane, and that's what he's paid to do. But there's a raging debate if you get back to that kind of potential GDP statistic.
You mentioned core PCE. Let's talk about inflation as well. 2.8% for 22 in a survey of ours. Lisa, the Fed at core PCE 2.3 for next year.
Yeah, how do
That's
they...
kind of the distinction right now, isn't it, between the Fed and everyone else?
Which is the reason, perhaps, why they're not pushing back on the rate hiking expectations in the market right now, John.
This is a market that's got its own forecasts. Your equity market, futures up 18, up 0.4%. A yield in a basis point, 10s, 161.50 from New York. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Laura Wright. UPS posted third quarter profit and revenue that beat estimates. The package shipper also raised its guidance for the full year. UPS's earnings were driven in large part by pricing gains. The company's price per package rose 12% in the US. President Biden will probably be unable to keep one of his key campaign promises to roll back Donald Trump's 2017 tax cuts. There is unyielding resistance among even some in the president's own party to raise taxes. The president already has acknowledged there aren't enough votes to raise the 21% corporate tax rate. Drug maker Eli Lilly has raised its full-year forecast. The surge in coronavirus cases spurred demand for its COVID treatment, especially among the unvaccinated. Lilly's third-quarter earnings fell just short of estimates. Meanwhile, the company says it is seeking accelerated U.S. approval for its experimental Alzheimer's drug. A warning from the Saudi Aramco CEO, Amin Nasser, tells Bloomberg that oil output capacity across the world is dropping quickly and companies need to invest more in production. Nasser says the supply deficit in oil markets could get worse next year if the coronavirus pandemic eases and more people fly. China has told the billionaire founder of Evergrande to use his personal wealth to alleviate the property developer's deepening debt crisis. Bloomberg's learned that Beijing's directive came after Evergrande missed an initial September 23rd deadline for a coupon payment. The demand adds to signs that China is reluctant to orchestrate a government rescue of the company. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I think it's very unlikely that the rate hike expectations are going to be delivered, and I expect at some stage in the first half of 2022 that we'll start to see evidence that the inflation isn't as sticky as people have been fearing, and maybe it starts to subside down towards the central bank targets towards the end of the year and into 2023.
Steve Major there of HSBC. If you listen very carefully over the last week, you'll notice the shift in the calendar. It's gone from year-end 22 to the middle of 22, Tom. Year-end 21 to the middle of 22. That's a shift now. Now there's transitory conversation. The test on the calendar for a lot of people seems to be the middle of next year, Tom. That wasn't where the story was at the start of this year.
Yeah, John, and again, that's the x-axis here, which I think we've really got to pay attention to, particularly in the ECB. Do we assume ECB's dovish, right?
We assume that, yes. And the big conversation for the ECB is December, Tom, when they work out what to do with the flexibility in their bond buying programs.
But, John, they love to put out those headlines. Are we going to see a 2025 headline?
I want to see the forecast, Tom. I'm with you. TK, I want to see the forecast year end going into next year. Okay. Can the T word hold up? That's essentially what we're asking here,
The T word is what,
right?
trillion?
Transitory.
Oh, I thought it was trillion. Let's go. 2.5 trillion Apple. 2.3 trillion Microsoft. Google, I can't do the math because they have two Googles. I think it's 3.6. I don't know what it is. I'm losing it. 1.7 trillion Amazon. Tesla, barely over a trillion. With your morning Tesla report, David Wilson. Go.
I mean, barely over a trillion, but, it's a matter of what you're comparing against. Compare it against all the other automakers in developed markets as represented by the MSCI World Automobiles Index. Tesla is equal to all of them combined. At least it was at the close yesterday.
How many GMs did it grow yesterday? I saw that in the Zeitgeist.
Like 1.5, basically. We're talking about a $118 billion increase in market value in a single day. Now, if you compare that to the total market value of all the other companies in that MSCI World Index, you find that one day's worth of increase in Tesla exceeded all the other total market values except for Toyota at $281 billion.
It's about electric cars. And I want to go back to what you and I talked about yesterday in the heat of this, and Eric Schatzker's reporting on Hertz and all that. How do the other electric car people respond to this reality?
Well, I mean, it's clear that they are spending a whole lot of money, you could argue, to play catch up with Tesla. We know that General Motors and Ford are doing that. So, it's a matter of how the industry is shifting. You could argue that Tesla's ahead of the curve. Does that make the company a $1 trillion business? Does it make Elon Musk 50% more valuable than Jeff Bezos over, founder of Amazon? I mean, these are the kind of questions that come up with the valuation of Tesla being what it is at this point.
And here's another question, Dave. Is it fair to view Tesla as a car company?
It's fair because that's where the bulk of their business is. I mean, you're right to say that, maybe there's something else going on. I mean, that they have the solar business from when they took over Solar City a few years back. They have battery storage, which ties into those rooftop solar networks. They certainly have aspirations to expand into other businesses. For the most part, though, they're a car company. They're certainly not valued like a car company, though. And that's where, things get kind of complicated in figuring out whether Tesla deserves this $1 trillion valuation.
Well, that's where I was going with this idea of what is in a valuation and when is it too high. I know that there were a lot of naysayers for Netflix for many years, and I also was raising questions about them borrowing as much as they did. And then they just got upgraded to investment grade by S&P yesterday. And frankly, people are saying that this was absolutely expected and should have been done a while ago. Tesla, a lot of people are saying the same thing. How many people are still pushing back on some of these stories versus embracing them and saying, you know what, we were wrong, and this is the new economy?
Well, I mean, there's still, some skepticism about the valuation. As we were pointing out yesterday, Tesla is the first, shall we say, non-investment grade company to reach $1 trillion valuation. So, you have to wonder whether eventually it's going to follow Netflix and get that, investment grade rating. So, that's something down the line. I mean, we know the auto business is capital intensive. So that's the challenge Tesla faces going forward.
David, John from England emails in and says, ask David, do you call it Alphabet or Google?
He's like, uh-oh.
There we go.
I call it both. Oh, Google's owner Alphabet.
I mean, and is Facebook going to do this? They're going to change their name.
Well, we'll see.
Or are they kidding?
We'll see how that one goes.
Alphabet, Google. There it is.
It'll always be Facebook, TK.
It'll always be Google.
It'll always be Facebook.
David Wilson, thank you so much.
Thank you, Dave.
What does Tesla do today? Go up another GM?
I don't know. Look, TK, the market's the market. How many people have been fighting this Tesla story now for how long? Yeah. The market is what the market is.
It is. And, again, I thought Liz Ann Saunders, again, out on Twitter last night, had a brilliant tweet showing the rest of the market. I mean, Tesla's not the market.
No.
I'm sorry.
Do you want to talk about JetBlue quickly, Tom?
Yeah, I missed that. I saw the headline, but go ahead,
about 3/4 of 1%.
Please.
Fuel price is a bit of a problem here. The loss narrower than expected, so we're positive in the pre-market. But going forward, they go on to say this sequential decrease is due to the seasonal leisure demand pattern, pressure from the recent material spike in fuel prices, as well as ramp-up related labour costs. Seemingly every company, Tom, dealing with the same thing in America at the moment.
Yeah, I don't know what aviation does. I mean, what do? Do they take out flights? I mean, I had a trip canceled, and the airline I was on just took out their flight. They just canceled.
Well, it's good to see the Atlantic travel corridor reopening, Tom, that corridor. So that's good news. I love this line. Lisa just put out this story on Twitter, so go and find it yourselves if you want to read it. This line from Larry Fink and Ray Dalio, that they're open to paying more tax, but only if the money was put to good use. And Ray Dalio saying this, Lisa: I would support anything that is going to have the effect of being spent on creating equal opportunity and greater productivity. If it accomplishes those things, I would support it. I'm not sure that it does.
Yeah, it's a really politically correct way of trying to push back gently on the plan to tax the ultra-wealthy individuals. Look, it's highly controversial, the idea of how do you go about doing this. And a lot of people are saying, why don't they just take a look at the taxes that are actually in effect and how to enforce them better before moving to raising the rates. Nonetheless, there is this political question for the leaders of all financial industry giants right now, John, and that is, how do you message that they are for something more progressive, even at their own expense, at a time when their industry is doing so well, even relative to other parts of the economy? And I do think that is increasingly a dilemma that you're seeing addressed here.
Our good friend and colleague Matt Miller went on a bit of a rant earlier this week, Tom, on Warren Buffett, and essentially said if Warren Buffett's so concerned about not paying enough taxes, he can just write the check to the Treasury. But Tom, he never does. Not my words, the words of Matthew Miller. early this week, Tom?
It's a loaded question, and the answer is this is so important, John, and I'm going to pick on Canada here. They made a radical tax change, and the government was voted out, and voted out thunderously. I mean, all the politicians have in the back of their mind, if they overreach on tax change, on tax policy, they lose their jobs.
And we're seeing that with corporations. I mean, to me, that's the most interesting thing. They are more willing, John, to raise rates on individuals than corporations because somehow that is less politically favorable. And that, to me, is pretty interesting.
I think a lot of people are surprised by that. Tom Keene, Lisa Abramowicz and Jonathan Ferro. Equity futures up 18 on the S&P. We advanced 0.4%. Record highs in this equity market. We keep on climbing going into year end. Heard on radio, seen on TV. This is Bloomberg.
Inflation is going to get worse before it gets better, but we are going to see these supply chain issues ease over the course of the year.
Everyone thought that we were going to get cost squeeze, and what we're actually getting is demand disappointment.
The sentiment is certainly shifting more bullish ahead of this week.
I think the big question is, has the labor market structurally changed?
We're a very, very, very long way from stagflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, within earnings season. Lots to talk about. Yes, it's the big companies. And here at 8 a.m. Wall Street time, a lot of smaller companies streaming out. All in all, John, a surprise. Earnings better than expected.
Yeah, the prevailing mood coming into earnings season, Tom, was one of fear, not hope. And I can tell you right now, it was fear of margins. And we just haven't seen that in a massive way this morning. Numbers from UPS, GE, 3M. So far, so good. And that's really been the story of the quarter. Yes, there have been some losers, but there's been some winners as well. It's over to big tech after the close, Tom. We get Alphabet and we get Microsoft.
Those matter, and of course, a real emphasis here on technology, and of course, many now trillion-dollar companies as well. John, it'll be fascinating to see the conference calls of big tech, how they frame out the holiday season and how they begin to get into 2022.
Into 22 with the bar getting higher and higher, and that's the concern around Jefferies. Looking at their commentary right now, Tom. Revenue grew at a high teens pace last year. It will be hard to sustain. Can they get it done again and again and again?
I read every word of Joe Feldman this morning with Dana Telsey on Amazon. And John, it's real simple. You look out at the ratios, and as Joe tries to get out to Q4, he gets out with a 16% growth margin for EBITDA at Amazon. That's just one statistic, but it's an example there of where people are heading.
Here's one concern, Tom, and it comes from Bed, and it's kind of what we were thinking about coming into earnings season. The supply chain disruption. Can the supply meet demand? What does that mean for an e-commerce giant like Amazon, never mind the cloud business? And I think that's a concern coming into a name that hasn't done much this year compared to the likes of Alphabet up 50, 60%, the likes of Microsoft up 40. Amazon compared to those two has been a struggle.
Lisa Abramowicz, it's amazing here how the conversation I'm having with John is removed from the wide set of other issues this nation faces. It's almost like corporate struggle in the pandemic is discrete and separate from everything else.
You mean the K-shaped recovery? The whole idea of
well said.
how
Yeah,
the
where'd that
market
go?
is not
Where'd
the
that
economy.
go?
Look, you're still seeing it in pockets. My issue is we still see some of the fiscal support, some of the checks that we sent out to lots of individuals here in the United States and sort of come into the spending, and you're starting to see people spend down their savings a bit more, which is what people were looking for. What happens next, right? People are talking about the fiscal drag that will eventually wear off, and then the real economy has to take over. Are we going to be there yet when we get to next quarter, when we get to the second half of 2022 and people actually start going back to the labor market in force?
I kid you, Lisa, about the auctions, but what is your estimate of the fiscal drag forward?
Well, and actually there's a two-year auction today, $60 billion of them, and I actually am really interested in them. I spared you earlier about them, but the idea
it's
here
important,
is...
Lisa, you carry on.
I do think it's important. The idea, how much demand is there at the front end at a time when the market is way out ahead of the Federal Reserve with respect to rate hikes? Do they dig in their heels on that yield, or do they move on?
Gets excited about auctions, Tom.
Unfortunately,
I get excited. I'm excited about supply as well. We get the taper decision next week. At the same time, most people in the bond market, Tom, expect the supply to roll over, offsetting the other.
You want to weigh in here on Braves Astros? Can we go there?
I'll take a miss. I'm wondering, Tom, how the Astros managed to cheat, apologise for cheating and still play baseball and beat your Red Sox. I'm struggling with that.
I watched the history last night of the Boston Braves and Milwaukee Braves. Frankly, I learned so much of how they came to represent Atlanta. It'll be. Is
this market not interesting enough for you that you had to go to
I just wanted
to
to bring it up.
Shall I talk about cricket?
But no, please
don't. Which is the baseball of the Commonwealth.
The only time cricket ever worked on Bloomberg Surveillance was I got a massive result, and I hope I'm pronouncing it correctly, from Perth.
From Perth.
Perth.
You speak to Rajan about cricket, Tom.
Perth.
He'll get going.
Okay, well, let's do this. Let's do the data check right now. We've got a good guest on what to do with the portfolio. Futures up 17. Dow futures up 112. John, the VIX 15. It's a bull market.
It's a bull market. All-time highs in this equity market. Up 17, advancing 0.4%. Yields in a basis point on 10s. 161.85. A snooze in the FX market. Dukes calling it a snooze. 116.17. And in the commodity market, Tom, 84 handle on WTI. Up a third of 1%.
We're doing something different right now. Vernon's Capital is in the absolute trenches of, okay, I missed this great bull market. What do I do now? They spend a lot of time talking to high net worth people about what to do in wealth management and how to participate scared stiff. Their director of Scared Stiff is Megan Horniman, and she joins us right now, director of portfolio strategy. Megan, how scared stiff are people in this great bull market?
I think that they're a bit more concerned with what they're seeing in the economy, but when it comes from an investment standpoint, you still have a lot of people that are looking at the equity markets. When you look at from a relative basis, the equity markets are the most attractive place to be right now, especially versus bonds. Bond yields where they are, we've seen a backup in yields, but they're nowhere near where they should be given the current economic environment and inflation environment.
When you look at what you do every day, are you finding within your strategy that you're going to rebalance into this great bull market, or do you let your winners run?
Right now, you have to be careful if you've let some of those winners run well over what your allocation should be. We're looking into the end of this year to take a look at some of our big winners, see if we need to rebalance, primarily because of the fact that we do see a lot of risks over the coming months in the equity markets, and it comes from some of the things that everyone continues to talk about. What will happen with margins, that we see rising pricing pressures and we see labor market shortages. These are things that you want to be a bit careful about. So we'll be looking to make sure that we're not too overweight in where we should be considering what our allocation is.
Megan, what's the ultimate call option, so to speak, to fade that story? To say, I wake up and feeling optimistic, those supply side constraints are going to ease through next year. Where do you want to be present in the equity market?
So with the supply chain easing, the economy is still on a very solid footing. So we still would look at some of those cyclical areas. We'd be very cautious around those expensive growth type of sectors because those are the ones that will be impacted by higher interest rates. And that is something that we think will occur. So you want to be in cyclicals. You want to look at financials. You want to look at materials. You want to look at industrials. These are the areas of the market. And then also small and mid-cap stocks as well.
All right. So in your view, Megan, has the 60-40 portfolio officially died?
Yes, this is not the type of situation where we are. We're coming off a 40-plus year bond bull market, and right now we're looking at interest rates that should be a lot higher from here, most likely will move higher from here. So with duration as high as it is in the fixed income market, you have to be very cautious around fixed income. The private market, the alternatives, this is another place to diversify your portfolios, but we'd be very cautious around that 60-40. It's not going to give you that same benefit. And the most important thing, it's not going to give you that risk reward that we have typically seen.
Megan, can you describe a tech stock that you would like? I know you can't do the single names with us. Just describe the business model that you'd want exposure to.
Honestly, I wouldn't buy tech stocks right now at all. I still think that they're from a little too expensive for me right now.
That's the easiest way of answering it. I just don't like them, John. Megan, thank you. Good to catch up.
Come on,
Megan
Horniman.
Verdant's Capital Advisors.
Describe the contours.
I get the notes, Lisa.
What it's like.
I know. It's called teeing up the guest. Just to let them.
Yeah, but what's important?
What does it rhyme with?
This is really important, John. The question you bring up, because obviously we all know there's different kinds of tech stocks, and what they're valuing is profitability, and critically, it's not Graham Dodd and Cottle profitability of net income. It's up the income statement as well, and that I'm sorry, we don't talk about Nvidia as one example. It's outside the FANG picture. But are they minting money? And the answer is yes.
I caught up with John Hancock yesterday, Tom. Emily Rowland, Matt Miskin of the team. They were talking about growth fading a lot in the back end of next year. And as growth gets a little scarcer compared to where we are, they like growth equities still. So it becomes a style story more than maybe a valuation story, Tom.
To me, that's Richard Bernstein 101, who I think is fabulous. And the style here is not growth, not value. It's profit. That can be measured free cash flow. It can be measured EBITDA, et cetera. But can you actually make profit? I mean, I just looked at a luxury maker. They're making 40 cents EBITDA on the dollar. They're minting
money. An announcement,
money.
Tom? You'll like this one. LVMH's Fendi and Kardashian Skims unveil a joint collection.
Yeah.
Are you excited about that? You mentioned luxury. I just saw that across the Bloomberg, just as I monitor the headlines.
These are symbols of New York City and the resurgence of New York City. Fendi moved across Madison Avenue.
Only you would know
into the old Coach store.
Tom's knowledge of luxury is ridiculous. It's ridiculous. Another announcement, this one a little bit more serious.
Please.
Senator Joe Manchin speaking with David Rubenstein, Tom, at the Economic Club of Washington, D.C. 9 a.m. If you want to watch that, do it on Live Go on the Bloomberg, Tom. That's one to watch.
Yeah, I got an email in from West Lafayette, Indiana, pointing that out to me today.
Does the individual, the author of that email, support Purdue by...
Well, you have to. If you're from West Lafayette, there's nothing else.
Of course. There's nothing else to live for, Tom.
Maybe the senator from West Virginia will boil her up.
College football, boil her up. What does boil her up mean?
I have no idea.
Does anyone have any idea?
Please.
Does anyone? It's like roll tide over at Bama. What does that mean? Boil her up.
It's Greek to me.
It's Greek
Tom,
to me.
are you lobbying for another day off? Is that what this is?
He's got one. I approved it. It's Monday.
Yeah.
He's got a long weekend.
I think the person who penned in the letter from Indiana actually approved that one.
Ask me, though. Always ask me. Always. Is it okay, John? And if I can have Thursday and Friday off, Tom can have Monday off.
Yeah,
so
good.
I'll be off Thursday and Friday, Tom, and you'll be off on Monday. Just a bit of separation.
Yeah, and Lisa's taking off November, so it works.
What do they say about love, Tom, and distance? It makes the heart grow, a little fonder and all of that stuff.
Oh, really?
All of that good stuff. That's what we're doing here.
Sensitive today.
Equity futures up 19, up 0.4 to 1% from New York. This is Bloomberg.
With the First Word News, I'm Laura Wright. The US and Chinese governments have made some incremental progress in their economic and trade negotiations. Treasury Secretary Janet Yellen and China's Vice Premier Liu He held their second call in around 4 months. Beijing described the conversation as pragmatic, candid and constructive. China has repeatedly said the US should lift tariffs on Chinese exports imposed during the Trump administration. Senate Democrats have moved closer to an agreement on President Biden's economic agenda. Senator Joe Manchin expressed optimism there could be a deal this week. He's been pushing to shrink the size of the social spending package. Still, some House lawmakers raised doubts about the terms of the deal being discussed. Singapore is taking another step toward reopening borders and reviving its economy. The country will allow fully vaccinated people arriving from Australia and Switzerland to enter without having to quarantine, starting on November 8th. Singapore recently opened so-called travel lanes with 10 other countries, including the US, the UK and Germany. UBS has joined its Wall Street rivals with a third quarter profit surge. The Swiss lender's wealth management fees soared the most in 3 years. Like a number of banks, UBS is looking to Asia to boost profits.
I'm strategically full on China. Absolutely. Who can't be, right? We country very well. We're very successful in the country, both in the onshore business and the offshore business. We have a very good combination of businesses in the wealth, IB, and asset management business, and we plan to invest more.
Meanwhile, UBS is starting a digital wealth manager in the US. It's targeting customers with less than $2 million in assets. Global news 24 hours a day on air and at Bloomberg Quick Take. This is Bloomberg.
they're very happy with over 70. I think by the time we hit 90 or triple digits, they may be getting a bit nervous about some demand destruction. So we're definitely still in the range that they're quite comfortable with.
Wonderful to hear from Ellen Wald, the Senior Fellow at the Atlantic Council. Just fantastic, which is why you spoke to her after I left yesterday.
Yes.
Tom, thanks for doing
that.
that.
You were working on another property.
Tom Keene, Lisa Abramowicz and Jonathan Ferro. Your equity market shaping up as follows. All-time highs, and we add some weight to that rally on the S&P 500, up another 20, advancing 0.4%. Yields in, Tom, about a basis point on 10s to 161.50 euro-dollar. Stronger euro here, euro-dollar positive a 0.1% to 116.19. And crude with an 84 handle, just about up 0.4% at $84.10.
Yeah.
Tom, I have no idea if this source is verified or not, but on Boiler Up, here's the history.
Oh, really?
Joe Tiller coached in Purdue from 97 through 08 and was loved by most students at the time. But before coaching at Purdue, he had coached at the University of Wyoming, also known as the Cowboys. During his time at the University of Wyoming, Joe Tiller used the phrase cowboy up, so he adapted that, Tom, to Boiler Up at Purdue, because they're the Boilermakers.
And
or something like
the
that.
The best part of this, John, is it's coming worldwide and across America and across the great Midwest with a British accent.
Which is why I need to go to the next game, Tom.
I absolutely. I think it says road trip.
Road trip?
Is it Michigan next, Tom?
There's like 14 bars on the main street there, and I'm sure there's one of them we can set up with it.
We could do some great work on digital over the weekend as we go and watch that game.
Yeah, they look great against Wisconsin. You mentioned 20 up here, John. How about gasoline up 20 cents?
Yeah, it's a
$3.19 bid up in the month. Now $3.39.
Do you want to talk about the economy, Tom? The economy or the politics of that? Or both?
It can be both. Let's do this. Damian Sassower joining us. So we're going to do something different this time around. We're not going to talk Brazilian real or Turkish lira. We're going to talk how he folds EM into the burgeoning price of hydrocarbons. Damian, when I say to you, and you're writing, what you write, if I say big higher oil prices, which nation does that affect outside OPEC?
Well, I mean, Tom, you're right in my wheelhouse here. You're talking about the reflation trade. You're talking about reopening. You're talking about the dominant theme in cross-asset allocation, and obviously that resonates with emerging market investors. So, look, I mean, where are we with copper? It was up 10% month to date, 27% year to date. I think oil's up 10% on the month, 66% year to date. Yeah, that's good for emerging markets, but not all of them, right? It's good for the commodity producers. It's good for South Africa and Russia. Not so good for places like Turkey and India.
What does it do to something like Indonesia? To me, the conundrum of Indonesia, besides a huge population, I barely want to call it emerging market as well, but your world cuts both ways for Indonesia, doesn't it?
It does. It does. I mean, Indonesia actually has kind of weathered the storm pretty well because of its hydrocarbon exports. But the problem with Indonesia is really just the fact that they're falling a little bit behind the curve. They've been pretty active in terms of injecting liquidity into the market and using the secondary bond market as a way to sort of to do that, which is never really a good thing if you're an emerging market with, relatively weak fiscal. So, Indonesia's a bit of but here's the thing about Indonesia. I mean, quite frankly, the currency has performed fantastically well amid it all, right? I mean, even though yields are relatively low compared to emerging market peers, it's still pretty attractive from a currency perspective, and I think we're seeing that in terms of investor interest here.
And part of that may be what's going on in China, the idea that people see the slowdown there and they say, look, people are going to try to diversify away from China with supply chains and other peripheral regions in the area will benefit. How much are you focused on China, on the fact that they're experiencing the highest pace of defaults and offshore debt in their history?
We're going to talk about coupon payments again, aren't we, Lisa? Okay, so Modern Land missed its principal and interest payment on a $250 million bond last night, which has the Chinese property sector, falling off again today. On the good side, we have Ronshine, who made a coupon payment yesterday, so that's a good thing. What's interesting is we have Evergrande. They have to make another payment due on Saturday. I don't know if you saw overnight, but the founder of Evergrande, Hui Kaiyan, was asked by Beijing to use his personal wealth to alleviate the deepening debt crisis. Good luck with that. Whose net worth, by the way, has fallen to under $8 billion from as high as
Wait,
$42
hold on a
billion
second,
in
Damian.
2017.
I want to stop you there because this idea that the billionaire owner of this company is being told by authorities, probably it isn't going to come to fruition, but to pay the coupon payment with his own wealth. What does that tell you in terms of the political backdrop for corporations and for an investor going into that region right now to somehow get bigger returns?
Oh, goodness. Well, it's not very good. But here's the thing. I don't think you can really discount the fact that who he's going to have to reach into his pockets here. I mean, Beijing has a way of convincing, the billionaire elites and the princelings that, they're going to need to take a pound of flesh here. And I think that might very well happen. But, I mean, let's be clear. I don't know if he's going to be able to come up with the $300 billion in liabilities that the companies do, right? So I take a step back and I say, look, he's made $8 billion in cash dividends since the company listed offshore. These Hong Kong listings, Lisa, we've had this conversation offline in the past. This is a way for a lot of local Chinese to crystallize their wealth offshore in dollars, right? That's basically what the Hong Kong, the H-shares market has done for the better part of the last decade. Now the question is he ready to bring it back onshore and alleviate the crisis? It's anyone's guess, but certainly Beijing will have difficulty, bringing those dollars back onshore. They can't really force it back.
The concept of limited liability here, Tom, not quite the same.
It's a little different
than
than
the rule of
English
law
law.
is just a little bit different. Let's just say that. Damian, thank you, sir.
Damian, thank you.
As always, Damian Sasser of Bloomberg Intelligence on China. We've seen so many growth forecasts, GDP forecasts get cut around China over the last week. Citi actually downgrading global growth. GDP from 4.4 for next year, Tom, down to 4.2. And the earnings downgrade is something they're looking out for. They say the following. My producer Jamie sent this one over. EPS downgrades are not necessarily fatal for markets, but when combined with monetary tightening and reasonably high valuations, it makes us nervous. Some nerves, Tom, into 22.
Yeah, John, I think you were working on one of your other properties. Earlier, we had Gabrielle Santos on, and she talked about the new China, and it's a really sophisticated look here at what the new China looks at after the Olympics, after the pandemic. I mean, I'm sorry, she's dead on. It's an absolute mystery.
It's 8:25, Tom, so typically, Lisa, getting ready for the production at 9 a.m., just a little bit later.
I'm beginning to wind it
Tom,
down.
you mentioned the Winter Olympics. Can you believe that's where we are still, given the trajectory of this pandemic, the origins of this pandemic, the fact that governments around the world haven't been able to get sufficient access to China to work out the origins of this pandemic, and we're talking about a Winter Olympics in China?
And you mentioned presciently yesterday, John, Davos. Davos is scheduled. But who says? I mean, don't we have to see more news?
We'll see the trajectory through Europe. I'm just surprised politically, Lisa, that this is how things have played out. I was unsure. If you'd asked me 12 months ago, do you think we'll have a Winter Olympics in China, given how things would go in relations between various countries, I was skeptical.
This goes to the same conversation that we have with our political guests who come on and saying it's getting really dicey between the U.S. and China. There is a new relationship that's much more controversial and much more pointed. And then you speak to investors and they say, you can't avoid China. You got to keep going into China. Or you say, you hear UBS's CEO come out and say that they're full bull on China. This dissonance is there as well.
John, you created a firestorm here. This is from Battleground, Indiana.
What are they saying?
They're saying boiler up, and I didn't know this. Harry's Chocolate Shop is a bar.
Okay.
We're learning. Thank you, Battleground, Indiana.
Is that on the stop? Is that on the tour?
I have no idea.
Another stop on a tour from Europe to Indiana, from New York. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market up 18, advancing 0.4%. Yields in a basis point to 162.91. We've had earnings from 3M, from GE, and the numbers so far from them and UPS, so far so good. That's the equity market story. And in the bond market, in foreign exchange, 116.14, euro dollar basically unchanged, positive 0.05%. And commodities with an 84 handle on WTI, 84.21. Tom Keene, Purdue, Nebraska on October 30th, 3:30 Saturday. You ready for this?
I am.
I asked management if we could expense the trip.
Did you?
Absolutely, it will be less than your daily Ubers, was the response. Oof. That's the official response. I thought that was kind, Lisa.
Oh, yeah.
Tom, we can go.
Oh, yeah.
Yeah, well, we can go. I like that, John.
I look forward to that too,
When we
buddy.
go, we can have a Negroni. John, we were remiss on earnings. We'd like to cover it globally and what matters to all of our audiences. I count 5 different kinds of people that watch. And a common feature, John Ferro, is Campari of Italy. And I'd like to point out they're up 17% per year.
Do you want to tell us why?
Each year for the last decade.
Yeah, do you want to add some more colour to that?
I'd like to add some more color to it. I can do that with bitters as well. You know, I'm sorry, John. The gloom, the worry that's out there, and some of these brands, they just grind it out with revenue. Revenue up 12% year over year, I believe, was the statistic for Campari. It's just another example of people getting it done.
Sales
Adapting.
574.8 million
17%
euros. The
excuse me.
estimate 549.8.
But is this really the same story? I mean, the alcohol companies have absolutely crushed it during the
No.
pandemic and beyond. Yeah. I mean, right? I mean, that's been sort of a story in general. I'm just saying, Negronis are very good. Carry on.
Thank you, Lisa.
Okay, there's your Negroni report
the skeptical
for this
pushback
morning.
against Campari as well?
No,
I know.
I'm just saying it was a specific story.
Let's go,
Move on. Let's go.
Let's go down and look at Tito's Vodka. We can do that in Texas. We do that with Regina Mayer joining us right now, Global Head of Energy at KPMG and a true force at Rice University and the Baker Center. What are you, open question. I rarely do this, Regina, but you're so good I'm going to ask it. What is your single point of study on hydrocarbons in America? What's the mystery for you into 2022?
Yeah, so let me try to boil it down, because I think what we're suffering from is a systematic and prolonged underinvestment in these long cycle projects. That is what it takes to bring oil and gas to the market. We see demand continuing to grow. The IEA said it'll be 96 million barrels per day, and others are saying it'll be pre-pandemic levels. We have tightening supply because countries are starting to worry about energy security, and countries that can are buying cargoes almost at any cost. So that's driving up all of that against the backdrop of an expectation of a cold winter, hotter summers. So we have crude oil up 60% over the last 6 months, natural gas up 131% over the last 6 months. And I think it gets worse before it gets better. That's what I'm thinking about for 2022, Tom.
Well said. The reality here is for the last 20 years on hydrocarbons, technology has saved us. Do you and the engineers at Rice and KPMG, do you assume there is new and improving technology, or is this as good as it gets as we produce oil?
I think technology will always continue to surprise us. And I never doubt the ingenuity of the industry, and in particular, the shale players. But what we've had is investors driving different kinds of behavior. And so your public shale players are sticking to the narrative of we're going to delever the balance sheet. We're going to return strong dividends to our investor base. And OPEC Plus, which can release more supply, is enjoying this $80+ rally to rebuild their government coffers because they've been suffering for budget deficits over the last 18 months during the pandemic. So yes, technology can definitely play a role, but not in this short squeeze where we're in today.
Regina, this is definitely a global story, but it's also a very U.S. story, in particular Cushing, Oklahoma. I was taking a look at a bunch of the stories about how much of a supply shortage there is there, how much the inventories have gotten depleted, and how that is distorting markets dramatically. How much is that driving a lot of the rally that we're seeing, frankly, globally, but driven from the WTI crude?
Well, I think WTI definitely is playing a key role because everyone's watching what the shale players are doing. But I think there's a Cushing story in all the global markets. You know, we saw the gas prices spike 10 times, 10x in the UK, not too long ago. There's again an energy security story there where 40% of natural gas supplies into the European continent come from Russia. So when we look at tight supply choke points like Cushing, like some of the systems in the North Sea, even what OPEC Plus is going to do, those little bubbles create the overall geopolitical story and drive a global commodity price that's really extraordinarily healthy right now.
What does $100 barrel of oil do, say, at the end of this year, early next year, as many people are predicting?
I think that's where we start to see probably pretty significant demand destruction, and probably where we start to see more increases in U.S. activity, which can be a swing producer, and we can return to being a swing producer. We're already seeing rig counts that are up almost double from a year ago. And while the public shale players are sticking to the investor narrative, at least I'm seeing a lot more private shale activity and more oil and gas development and production coming in the Permian and elsewhere in the U.S.
How do you respond to market strategists, to Wall Street types with a vector to $90 or even $100 a barrel? How do you respond to that as an academic?
Well, I think, I mean, it's a real economic challenge, right? I mean, that's what the underlying value of the commodity is today. And I think that's where we have to look at what's going to happen in Glasgow and COP26. How do we accelerate the energy transition? How do we address energy security? And how do we ensure that the market forces keep energy affordable and reliable and a planet that's consuming more and more, every day as we continue to grow?
Within oil here, the overlay has already been gas. I remember the Exxon transaction. Everybody had to get into some form of nat gas and the rest of it as well. After Anadarko, after Occidental Petroleum, what's going to be the synergy that we're going to see in American oil? What's the next combination that just has to be done?
Well, I think you've seen those combinations already, Tom. So I think there's a lot of consolidation around shale assets in the U.S., which will help because scale, as they say, shale means scale, and that'll help from a cost perspective. So even if oil ultimately comes back down to below 40, we can still be profitable with those larger players. And you see the international oil companies pivoting more to have a more diversified portfolio in the energy transition. Some are betting more on carbon capture and storage. Others are betting more on hydrogen batteries. Others are betting more on renewables. So I think you'll start to see a bifurcation of the traditional energy company strategy with sort of the new energy company strategy. And that will help balance the power needs that the planet has today, as we pivot into the energy transition.
Regina,
Glasgow and COP26 will be very interesting to see.
Regina, before we let you go, there's been a dilemma for a lot of investors that want to move toward more ESG type strategies, that want to seem like the good guys investing in greener energy. And they have missed out on a rally that's been dramatic. And a lot of analysts have come on this show and said, if you invest in oil companies, you'll do great. How do you sort of see that developing in terms of investors both getting the returns, but also being able to sleep at night with how they're putting their money to work?
The sector took a beating last year that I didn't think was necessarily warranted. So I think there's definite upside. And for those of us that stayed in our oil and gas commodity equities, we're doing really well in our portfolios. But I think what I would say is investors need to have a balance and don't count out the energy industry. We have to be a key part of driving into a lower carbon climate. If we're not at the forefront of driving that, then I don't think that we are able to achieve a 2 degrees C, a 1.5 degrees C scenario. So I encourage investors to look at the bigger picture. Don't demonize one side versus the other, because we need an all of the above strategy to get to the climate goal objectives that we have together. So don't just look for what sounds green in the short term. Look at a balanced portfolio, because fossil fuels and hydrocarbons have to be a core part of the underlying part of the portfolio for a substantial period of time. And we will reduce the carbon footprint of those hydrocarbons. The industry is committed to that.
Regina, I've really enjoyed listening to you. Thanks for being with us. Regina Mayer there of KPMG. Crude this morning, Lisa, up 0.2% on Brent, 86.19 on WTI, up 0.4 to 84.7.
You've seen that gap between, frankly, WTI and Brent continue to shrink as frankly, it's Cushing, Oklahoma supplies really get beaten down. And you do wonder about exactly what Regina was talking about, the shale producers as the swing production outlet here. They're not coming back online in the way that they used to. And what's it going to take? Can they, if prices go up high enough?
How expensive is it now, Tom, to travel to Indiana? How much fuel do we have to burn?
No, you mentioned JetBlue earlier. I mean, John, this is a serious issue. Where, with the price of oil, when it clicks in, what's it going to do? And we need to go to West Lafayette.
You've done the
sooner
research,
rather than later. We've done the research. First class Delta Airlines, $4.99. It's a reasonable price to
return,
Indianapolis.
Tom?
No, yes, that includes return.
Okay.
And then, John, Greyhound, Indianapolis to West Lafayette. Greyhound economy flexible is $76 round trip. We could do that.
I can see you on a Greyhound. Have you ever been on a Greyhound, Tom?
Maybe long ago.
No. How long ago was it? I've been on a Greyhound. Have you been on a Greyhound?
Yeah.
Do you fit in the seats?
No, not sort of. It depends. If I have a case of Jenny beer with me, I don't.
Do you take a case of beer on the Greyhound with you?
Why? Who
does? So that's us. Are we going to film this, Tom? We're getting a Greyhound to Indiana.
John, I think these are reasonable expenditures to get a sense of the reach across America.
How long does that take? How long is that coach ride to Indiana for 99 return?
No, Delta's quick. It's like, are they in the same time zone? I don't even know. But Delta's not the issue. The issue is Greyhound. They stop at every little town on the way to West Lafayette.
I've done it, Tom, a long time ago. Esty Twex joining us on the Open, CIO at Flowbank, wondering if this conversation continues. Esty, stick with us. It won't. In the bond market, 163 on 10s, futures up 0.4%. The earnings have been decent. UPS, 3M, GE.
Sound like Lisa.
After the close, Alphabet, Microsoft still to come. From New York, heard on radio, seen on TV. This is Bloomberg, and I'm told it's 16 hours on a Greyhound. 16, Tom. You've got this.
With the First Word News, I'm Laura Wright. President Biden will probably be unable to keep one of his key campaign promises to roll back Donald Trump's 2017 tax cuts. There is unyielding resistance among even some in the president's own party to raise taxes. The president already has acknowledged there aren't enough votes to raise the 21% corporate tax rate. UPS posted a third quarter profit and revenue that beat estimates. The package shipper also raised its guidance for the full year. UPS's earnings were driven in large part by pricing gains. The company's price per package rose 12% in the US. Drug maker Eli Lilly has raised its full-year forecast. The surge in coronavirus cases spurred demand for its COVID treatment, especially among the unvaccinated. Lilly's third-quarter earnings fell just short of estimates. Meanwhile, the company says it is seeking accelerated U.S. approval for its experimental Alzheimer's drug. China has told the billionaire founder of Evergrande to use his personal wealth to alleviate the property developer's deepening debt crisis. Bloomberg's learned that Beijing's directive came after Evergrande missed an initial September 23rd deadline for a coupon payment. The demand adds to signs that China is reluctant to orchestrate a government rescue of the company. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
The fact that you just see inflation receding back towards the target over the second half of next year, I think that's going to help the Fed be patient and continue to wait for more workers to return to the labor market and that labor market picture to strengthen without getting too worried that inflation is becoming unbridled.
Sarah House, Wells Fargo there with some very good intelligence on market economics. We've had a very strong day of talking about economics. Finance investment, we're focused on earnings. For Lisa, futures up 18. Look at Lisa, the VIX, 14.99.
Yeah, kind of not doing anything. The amazing aspect of no volatility at a time when people still have so much economic uncertainty, Tom.
And what's so uncertain here within the great move of yields moving from a high level, think Volcker, on down, is you can count the bear markets on one hand and they have fingers left over. And someone who's done that is Barry Rittenholtz with Bloomberg Opinion Now. And we're going to go someplace, Barry, right now that maybe is just starting. And that is on a given bond fund that I looked at. I believe if yield goes up, price goes down. And I have had evaporate 33 months of coupon in just a number of quarters as well. What do you do when a bond investment goes down in price?
Well, after 40 years of bonds going up in price, eventually the bottom is being formed. We've seen a lot of fake outs and false bottoms over the past couple of years. If we believe the message of the markets that this economy is starting to decelerate but will remain strong for the next couple of quarters or years, you have to live with it. You can't make yield out of nothing.
My great measurement here, and this goes back to ugly bond markets, some would say uglier than anything like we have right now, is people get 3 statements in a row, 3 monthly statements, 3 quarterly statements, and they go, oh, it went down. How close are we to that emotion right now in the bond investment world?
I don't know anyone who's really paying close attention to the bonds
No
when
one's paying attention.
the equity markets are more than making up. What's the worst year ever in treasuries? Down 4.5%? Your
Exactly.
worst year. Meanwhile, equities, hence the advantage of 70-30 over 60-40 this quarter, this year, you just have to accept the fact that bonds exist to be a little bit of a volatility dampener to equity.
Coupon on the way back.
And that's pretty much it. P.S. Normally, if fresh money comes in and someone says, what am I going to do with rising rates as we normalize the Fed? Well, a bond ladder works well because as bonds come up, they're replaced with higher yielding bonds. P.S. That's been a disaster for the past, 4 decades. So,
But Barry, exactly to this point, I mean, honestly, there was a story out in the Bloomberg terminal earlier this week that got a lot of attention that basically talked about the biggest yearly loss that we're seeing right now in global bonds going back to 2005 and potentially poised for the worst since the late 1990s. How much are we entering a new terrain, especially with inflation expectations moving up pretty significantly at a time when we do have some new characteristics in the economy?
So, do we want to get into the inflation discussion, or we want to just put that aside and stay with? All right. So, I think most people are getting inflation wrong. Although Sarah House from Wells Fargo seems to have the right concept, as does Kathy Woods. You know, the dominant backdrop is deflation, not inflation. We have all of these supply chain problems, all these reopening issues, and making it more complex is the fact that we've had a massive bottom half of the labor market catch up, a reset. And you're not going to see the same sort of wage gains in 2023 that you're seeing in 2021. So that's a lot of cross currents. Depends on where you look. You want to see inflation, look at wages. You want to see deflation, look at technology. And let me point out, I'm always shocked when people talk about energy and oil prices. Here we are, what are we, $83 a barrel? I tanked up the other day $4.17 for premium. I was paying almost $6 in 2007 for gas. We're all the way back to 2015, 2016 on fuel prices as the entire country becomes far less energy intensive as a service economy, not as a manufacturing economy. So the focus on energy is just completely misplaced. Stagflation, I don't know what these people are talking about.
Okay.
I don't know what they're smoking.
All right, so Barry, putting those assertions aside, there is an issue right now, especially as we talk to fund manager after fund manager saying 60-40 is dead, that the idea of using bonds as a ballast in your portfolio has gone away. You need to go into private assets. You need to look to alternatives in order to get that same kind of offset to the risk that you're assuming in equities. Do you disagree fundamentally? Because in your view, it has not changed from the disinflationary trends that we saw in the past couple of decades.
So you always have to be careful about reaching for yield, whether you're going out on the duration or in this case on the private side on going out on higher risk levels. Nothing is safer than U.S. Treasuries. So if you're going to replace Treasuries, you're going to replace TIPS with some combination of private equity, structured note, real estate, whatever it is, you're assuming more risk. As long as you understand that and that this is no longer the volatility dampener, instead you're focusing on the yield portion of this, then that's fine. But recognize private equity is not a substitute for treasuries. Yes, you get the coupon, but you lose potentially some of that ballast. Good news, they only mark to market once a year, so you're not getting the daily volatility, but you're still dealing with increased risk. There's just no other way around.
Very quickly here, and we could go on here for 2 hours. Is private equity a substitute for institutional responsibilities within a retirement plan? I mean, what's the downside of private equity? Right now, it's everyone's nirvana.
The downside is, the upside is you're getting this illiquidity premium, and especially with not being tied to the market, you're getting some diversification.
Agreed.
Some lack of correlation, especially if people stay true to their charter and not just become AUM machines, which is always the
exactly
the
that's
fear.
the risk here.
That's the risk, that they'll go down the quality scale in order to continue bringing
because
in...
the money's just piling in, and what does that do to IRR? What does that do to the internal rate of return of these investments?
There's only so much inefficiency in that space, and as more and more dollars flow in, listen, there is no forever asset class. Everything eventually becomes so efficient that the returns relative to the risk have to moderate. And that's what you're seeing take place in private equity. P.S. I don't know if it's at $5 trillion or $10 trillion, but eventually we'll hit that number.
This is a really, really important conversation. We'll continue this with Mr. Ritholtz. The idea of arbitraging away the return of private investments. Maybe that's a story for next year or even the following year. Barry Ritholtz, of course, writing it up for Bloomberg Opinion, and he's got a podcast that is better than good, to say the least. Lisa, your observation on futures up 17.
The idea here, you can't keep them down, and that people are talking about how earnings are actually delivering what people were expecting, and we've stopped talking about valuations anymore, and how they are largely pinned to this idea of a low yield for longer environment that Barry was just talking about, and I think that's very much the story right now.
I'm going to look for dynamics in the interest rate market as well, with a 10-year real yield negative 1.05. That's new in recent territory as well. There is a political debate in Washington, driven forward by balance of power. The senator from Ohio, 12 noon. Stay with us on radio, on television. This is Bloomberg.